This economy is actually performing better than expectations. There was reason to suspect that there's a lot more runway for growth than people had been anticipating.
We are simply growing better. Look at the recent IMF revisions. U.S. up in terms of growth rate.
There is a bit of a disconnect, I think, with a lot of the data points that have been coming out.
We know it's potentially an important inflection point, depending on which way U.S. policy goes in many areas.
At the moment, we're sitting at a place where the soft landing has happened, and the Fed is incentivized to keep it going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Your week started live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 up by 0.6%, looking to snap back from a week of losses on the S&P 500, going into an absolutely stacked week of earnings. It is the best week of earnings season. Microsoft, Apple, Google, Amazon, and Meta. Then we've got the economic data, concluding with payrolls on Friday. The median estimate in our survey is 110. The high is 164 at RBC. The low, negative 10K at Bloomberg Economics.
The difficulty here is just how muddied has the water gotten given some of the strikes, given the hurricane. Pantheon Macroeconomics came out and said that strikes will likely cut the payrolls by 40,000. Hurricane Milton probably cut it by 25,000. So pick your number. To me, the biggest potential surprise is an upside surprise representing strength. And that is what I wonder is if that's going to get the bigger response potentially in the bond markets.
Absolutely, because also the wide margin of these calls, this out of consensus call from Bloomberg Economics, how bad was that Hurricane Milton effect that it would be a negative 10 print? And also what is going to be interesting in this data is the revisions from the blowout September report. Are they revised lower or higher at 254,000? But all of this comes 8 days we are away from the U.S. election. All of this data is going to drop when we have a U.S. presidential election and then the Fed meeting, potentially not knowing the results of that U.S. presidential election.
We've got a lot to get through this morning, including this move in the oil market. Crude is down by close to 6% on Brent. WTI seeing that move right now, 67.39 on WTI crude. Limited strikes on Iran.
A sigh of relief, really, in the oil market by the fact that no supplies were disrupted. When Israel decided to directly attack Iran, they didn't go after civil, nuclear, or oil facilities. So the market is breathing a sigh of relief. You had the administration come out late in the evening, Friday, talking about that they think this is the end of this direct cycle between Israel and Iran. But of course, you have to think the end until when?
I have to ask, really, is this de-escalation? They went after some really significant military assets, including their possibility of making fuel for some of those long-range ballistic missiles. You have to wonder how much this really is the end of the conflict and how much this de-escalates. And frankly, the ball now very much in the court of the Iranians, and it is not clear how they are going to respond.
In absolute terms, it's not good. I think we all agree on that. But it's always relative to markets, and markets were anticipating the very real possibility that energy infrastructure might be struck. The fact that they didn't strike that over the weekend, you take out that premium, we're down 5 to 6%.
Fair enough. This market is binary. That immediate threat not there, okay, we can put it off, and evidently that's not going to be imminent. So that is absolutely the sigh of relief that you're seeing in markets today.
Not a sigh of relief for Boeing. That stock is down by 0.9% in the pre-market. We're reporting here at Bloomberg that Boeing is considering a $15 billion capital raise. Lisa, that would be the largest equity raise in the last 4 years.
Trying to stave off some more time and potentially avoid getting downgraded as the strike does continue. A real question here with Boeing. Even if they do get some sort of reprieve from the downgrade, how much can they really get confidence from their investors at a time where it's not clear what they're going to look like? The Wall Street Journal reporting they were going to divest some of their aerospace space intergalactic
Starliner.
Sites. Yeah, the Starliner. Thank you for saving me there. But that, to me, really highlights what's on the table and potentially the changes that could come down the pike.
Historically, the Starliner is part of American history, so that would be huge if they decide to look at options potentially of selling this asset. That was one thing we learned over the weekend, as they need this boost to liquidity, potentially raising those funds. And third, the Department of Labor going back to the drawing table with the union saying, come on, guys, you've got to get back to the table. This is the 7th week of those workers on the picket line.
That's the stock to watch this morning. Here's an asset class to watch, the bond market. Bond yields this morning a little bit higher, up by 2 basis points on a 10-year, 4.26. the climb resumes. It's not just the economic data, a lot of supply this week as well.
I'm so glad you mentioned that. It's not only supply, but we also get quarterly Treasury funding announcement coming out on Wednesday. But we have a stacked lineup of bond auctions. And I want to say it's unusually stacked because they actually brought forward a lot of the auctions. So we have $69 billion of two-year notes, $70 billion of five notes. That's just today. And then tomorrow we get $44 billion of seven-year notes, all at a time where it is very unclear what the longer-term trajectory is for both the deficit as well as inflation. This is a significant concern. I just want to read what Peter Scheer had to say because I think it's important. Despite the election looming, bond vigilantes and earnings are likely to be bigger drivers of this market than anything else as we head into month end.
We did that just for you.
Thank you.
That was just for you. We'll speak to the man himself who coined the term bond vigilantes in just a second as well. Ed Yardeni of Yardeni Research, looking ahead to a busy week of economic data. Former US Ambassador to Switzerland, Ed McMullen, on Trump's rally at Madison Square Garden. And Roule of CSIS following Israel's limited attack on Iran. We begin this hour with stocks bouncing back from their first weekly loss in 7. Traders looking ahead to the last big data point before the Fed's next decision. Payrolls due on Friday. Ed Yardeni of Yardeni Research writing, the data since the last meeting of the FOMC suggests the 50 basis point cut that occurred was probably too much, too soon. That raises the risk that price inflation might stop moderating and that stock prices might continue to mount up. Ed joins us now for more. Ed, welcome to the programme, sir. Let's start with the stock market. Are you calling this a melt-up?
I think it has been a bit of a melt-up. I mean, look, we're looking at valuation multiples that are getting right up there, close to where we were right before the tech wreck in the late 1990s. We saw a melt-up that got the forward PE of the S&P 500 up to 25. Now we're at 22, so it's starting to look like it.
Ed, we're seeing bond yields back up as well, higher again this morning by 2 basis points at 4.26. Can we sort of fold the election into this conversation as well? Do you think the election and a GOP sweep potentially would open the way to a move back towards 5% on a 10-year?
Unfortunately, it is a conceivable scenario. The bond vigilantes are definitely mounting up. I mean, the low bond yield a few weeks ago was 3.65%. And now we're at 4.26%. I think overnight we got to 4.285%. Yeah, I think there's a possibility here that if we get a sweep, either the Democrats or the Republicans, the bond market will conclude that nothing will stop either party from spending a lot, maybe cutting taxes a lot for some folks, not for others. And all in all, continuing to widen the deficit and the debt. Meanwhile, the interest payments continue to accumulate, and we'll probably hit $1 trillion, which will make lots of headlines within the next few months.
And I have to say, it's a very compelling argument to me. And I worry about the deficit, and I watch the bond auctions, and I see the increasing size. And last week, I was in Washington, D.C. with all of these international central bankers and these international bankers. And where do all of their clients want to put their money? Even with all these concerns, they're talking about the U.S. election, the deficit, the United States. They still want to come here. So what is going to make people say, no mas, we're done?
Well, that's a good point. I mean, the reality is that the dollar's actually strengthened at the same time as the bond yield has gone up. So that suggests that there are people are concluding that if the bond vigilantes are getting the message out to the Fed that they don't want any more rate cuts, that they think it was premature, that strengthens the dollar, which means that people are buying these bonds. So I wouldn't get too excited about the bond yield going up to 5%, but it's certainly looking more realistic than it did a few weeks ago. And a few weeks ago, we thought that the Fed did cut prematurely, that the economy was going to surprise them to the upside, and that's exactly what's happened.
There's also been a contradiction here. People used to think that higher bond yields would excise a pretty big tax on equity valuations. What we've seen is this melt-up continuing despite the melt-up in yields.
Yes.
What we have seen, though, is a change with that rotation being challenged into small caps and into the other 493 stocks. Do you think that is what this is going to look like into year-end?
Yeah, well, I think if, in fact, the market is starting to perceive that the Fed isn't going to ease as much as they thought after the 50 basis point cut on September 18th, then I think the market starts to get cool off to the idea that the Russell 2000 is going to outperform and go back to the S&P 500 and maybe even go back to just 7 of those stocks, the so-called Magnificent Seven. And look, to John's point, I don't want to get too worried about a melt up here on a valuation basis if it turns out to be an earnings-led melt up. We certainly have had Tesla, for example. Maybe it wasn't so much earnings as hype, but as you folks point out, this is going to be a busy week for earnings, and we could have some upside surprises from the Magnificent Seven, which would drive the NASDAQ to further record highs, even in the face of bond yields going up.
Ed, I want to get back to where you see bond yields going, because you say that we could get higher yields regardless if it's a Republican or Democrat sweep. But when you look at how the Senate races are looking to go, it looks like you can pretty much take the Dem sweep off the table. If there's going to be a sweep, it's likely going to be red. So tell us a little bit more what that could mean, not just to yield short terms and long terms, but also other assets.
Well, it gets as confusing as Trump's policies are confusing. You know, the idea of raising tariffs across the board by 20% and against China 60% is probably a bargaining position. I mean, it's hard to imagine that this administration would get advice from its own economists saying that that would be a good idea, because it certainly would be inflationary. So bargaining chip for the deal maker Trump would make sense, but as a realistic alternative to taxes and incomes, that doesn't make that much sense. On the other hand, Trump wants to produce more oil, which would be disinflationary for the U.S. But there's no discussion by either candidate about doing anything to reduce the deficits, to deal with the debt, to deal with the exploding net interest expense of the government. So I think the bond reaction to a sweep, as I said, by either side, I want to be balanced about this, but you're right, the sweep is looking increasingly, if it's going to happen, it would happen with Trump winning because of what you said about the Senate and the House. And in that scenario, the bond yield, I think, easily goes to 4.5%.
Ed, take us through what can happen if this election drags on or if it's contested.
I don't even want to think about that possibility. The country is so partisan that, you know, we've been kind of driving ourselves mad here with the political partisanship, and to have a closely contested election would be very unsettling to the bond market, to the stock market, to all of us, I think. It would be resolved of, obviously, at some point we will have a president. But if it takes months, it could mean that the rest of the year will not be a great one for the financial markets.
That is the market nightmare very few want to see. Ed, thank you, sir. Ed Yardeni of Yardeni Research. Equities doing better this morning, up by 0.6% on the S&P, with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The yen weakening this morning to a 3-month low. Japan's ruling coalition failed to win a majority in parliament for the first time since 2009. The concern that political instability would translate to a less hawkish BOJ. Prime Minister Shigeru Ishiba promised to restore stability, indicating that he plans to forge ahead with putting together an administration and continue on as prime minister. Olympus shares are falling in the Japanese trade. The company pushed out its CEO after investigating allegations that he purchased illegal drugs. Stefan Kaufmann, who was on the job for less than 2 years, resigned all positions effective immediately. Olympus is best known as a designer of cameras and imaging gear before a pivot into medical equipment. The company declined to comment, citing the ongoing investigation. Indonesia has blocked Apple from selling its iPhone 16 in the country. Officials say that the company hasn't met local investment requirements. Now, Apple does rank outside the top 6 smartphone brands in Indonesia, but it's a potential growth market with a young, increasingly tech-savvy population. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. A little bit of breaking news out of Germany. This coming from the VW Labour chief. Volkswagen seeking to close at least 3 German plants and downsize all remaining plants in the nation. Some big news potentially for Volkswagen and the German economy.
Yeah, this actually was somewhat expected just because we had heard warnings to that extent, and yet interesting that we have not heard from policymakers what they can do. This from the Works Council Chief Daniela Cavallo, who also sits on VW's supervisory board. This means taking out even more products, quantity shifts, and entire assembly lines far beyond what we have already done so far.
Is this the decision or a start of a bigger negotiation with interested parties. I sent us the letter.
There is going to be an even greater push saying if you want this industry to be here and to be thriving, you need to provide us some help.
Ollie Crook out of Berlin joining us in about 15 minutes' time on this story. Don't miss that. Up next on this programme, Donald Trump headlining The Garden.
We must defeat Kamala Harris and stop her radical left agenda with a landslide that is too big to rig. Kamala, you're fired. Get out. Get out.
That conversation up next, live from New York City this morning. Good morning. Live from New York City, equity futures up by 0.6% on the S&P 500. Under surveillance this morning, Donald Trump headlining The Garden.
We must defeat Kamala Harris and stop her radical left agenda with a landslide that is too big to rig. This election is a choice between whether we will have 4 more years of gross incompetence and failure, or whether we will begin the 4 greatest years in the history of our country. Kamala, you're fired. Get out. Get out.
So here's the latest this morning. Donald Trump amping up supporters at a packed Madison Square Garden during a nearly 6-hour rally as the race for the White House enters the home stretch. The former president was backed by dozens of speakers, from Elon Musk to House Speaker Mike Johnson. Joining us now around the table, former US Ambassador to Switzerland, Ed McMullen, who was there in the stadium. Ambassador, good to see you. Good morning.
Good to see you. Good morning.
We've got to start, unfortunately, with a comedian called Tony Hinchcliffe, who made some disparaging remarks about Puerto Rico. How unfortunate is it that this event is being overshadowed by that? And what's your reaction to that this morning?
Well, I think that the American people are smart enough to sift through the nonsense. There were probably 30 speakers that spoke, including the president, the vice president, all of whom were focused on the economy and the future of America. And for the media to fixate on one comedian who I never even saw. I was in the motorcade with the president. He got on early. Never even heard him speak, so I don't really know what he said. But I can tell you now, what everyone else was saying was right to the point, right to the heart of what Americans truly care about.
But, Ambassador, with all due respect, it's not the media. It's the Republican Party. You had Senator Scott of Florida coming out denouncing those comments. You had Congressman Anthony D'Esposito of New York 4, who's in a very tough race, who is Puerto Rican, coming out and denouncing those comments.
Yeah.
Isn't that a failure so close to the election? Do you feel like this could potentially be that Hillary Clinton deplorable moment, given the population of Puerto Ricans in Florida, in Pennsylvania, in swing districts like New York?
So I don't think there's a failure at all, because I think the president directly addressed yesterday, are you better off today than you were 4 years ago? That was the heart of what that rally was about. And I can tell you, the American people understand the nonsense. A comedian who makes remarks that were clearly not acceptable remarks, people have denounced them. I think you've heard people all over the spectrum denounce them, is not going to take over a rally that was historic. I was with the president in the motorcade from the tower down to the garden. 100,000 people lining Fifth Avenue, cheering on the president in MAGA hats in Manhattan. That's the story. That is a major story. And it's not going to be a comedian who started off early on in the evening where no one really saw what he said. Now, we're seeing it today. He's probably the most famous comedian in America today, and I'm sure that there'll be plenty of media making him that. But we're not going to talk about that. We're going to talk about what matters to real Americans. And real Americans, Donald Trump spoke to the Hispanic community, the African-American community, and all of America. And when I went down on the floor, because I got out of the box and I went down there to see and hear what real people were saying, people from all over New York, all over New Jersey, all over the area in this community, really ready for change, because they're hurting. Their economic well-being has been damaged over the last 4 years, and they're ready for a change.
Last night really felt like the RNC Part 2. And even you had the former First Lady give a speech, which she didn't do at the RNC. Do you think he's making his closing pitch too late? That moment, are you better off today than you were 4 years ago? Yeah. Shouldn't that have been the pitch at the debate against Vice President Harris?
No, I think the president's made this very clear from the outset. Are you better off today than you were 4 years ago? He started that the first thing he said when he got to the podium. And I think the American people know they're suffering. You get out into the real world. I live in South Carolina. You get out into the countryside. People can't pay $8 for a pound of bacon. They can't pay $50 to go to McDonald's. This is the real world. Donald Trump's speaking about it, addressing it, and he has a plan to deal with this. We've heard nothing from Kamala Harris, nothing.
Well, there's, in all due respect, there is a more than 80-page document that is her economic plan, and we have heard about her economic plans, and we've talked about them. So there is a plan that she has and that she's laid out. I don't want to just let this go, though, because there is a question about what that rhetoric does, because it wasn't just that comedian. It was also Tucker Carlson calling Harris Samoan Malaysian and low IQ. There has been an ongoing discussion trying to castigate the other side with certain types of pejoratives. I'm just wondering what tone you think that sets and whether that's an accurate tone to reflect
personally,
Donald Trump.
I think the real focus here is the future of America. And I'm not going to get drawn into a conversation about what other people are saying about other people. It's done on both sides. Donald Trump is called Adolf Hitler. Where's the outrage? Where's the outrage? The outrage is always when a Republican has something to say. Don't agree with what was said by that comedian, but I can tell you this. We're going to focus on the things that Americans care about. We have focused on it. The president's focused on it. It's the reason he's winning in every major battleground state right now today. And it's the reason he will win the election.
You talk about focusing on economic policy. Elon Musk was there, and he was talking about $2 trillion in cuts to federal spending. We've heard this discussed before. I'm just wondering what this looks like, if this is something that he's worked on. I remember when he was going to take over Twitter, and he said, I was going to slash all the employees, and people said, no way. And he went in, and he actually slashed more than 80% of the staff. Is there a plan to actually do that type of effect?
Well, and look how well Twitter's doing today, thanks to Elon Musk. It's actually open. It's changed its name. It's a completely different company. It's efficient. I trust Elon Musk to make good economic decisions. Now, Elon was asked that question, how much do you think he can slash? Off the cuff. It wasn't a plan. The $2 trillion cut was what he says he thinks is the fat in the government that could be cut. It's not the Trump plan. However, I do think Elon Musk last night, the reception he received was mind-boggling, because these are not New York and Washington Politico people. These are real people from all over America. I think they respect that he respected free speech, that he's built the kinds of company he has. He's an entrepreneur of major magnitude. And the fact that he's going to play a role in helping the president set the economy straight in the United States is something a lot of people are excited about.
I want to sit on the tech space because you sit at this intersection close to the former president where you get a lot of calls, I know, from foreign dignitaries, but also a lot of individuals in the business space. Over the weekend, Donald Trump also shared a story about the Google CEO calling him up and saying how great his stunt at McDonald's was and how much of a, quote, hit it was in Google. Are you seeing a shift in big business towards wanting to make sure they're preparing for Trump 2.0?
Yeah, I'll tell you, I think one of the big surprises I've had in the last week to 10 days is Democrat friends of mine who run businesses, entrepreneurs, who've supported Kamala Harris and who have actually said, look, I think I need to give the president support. How do I do that? Well, we found a way for them to do it, and they're doing it. And I think when you see the
because they believe in him, or they see the writing on the wall?
I think they see the writing on the wall, but I think they also realize the economy is the future, right? And Americans know that this economy cannot continue. You say Kamala has a 60-page plan. Where's that plan been for the last 4 years? Where has she been for the last 4 years? Suddenly there's an epiphany on how we solve the economy. Donald Trump's done it. He had 4 years to do it. And that is why I think the American people realize he's the answer to the future.
Ambassador, you are always generous with your time. We appreciate it this morning. Thank you, sir.
Great to be with you.
Thank you. It's good to see you. Ed McMullen there, the former US ambassador to Switzerland. Just that note at the end of the conversation, you can sense that shift in the last few weeks.
Not just from Google, but also, I think, really from Amazon's Jeff Bezos, not only allowing the Washington Post to not go with their endorsement. They've had it written for Kamala Harris, but also these reports that there's been some conversations between the two.
Some news to get to. Up next on the programme, the latest out of VW from Berlin. We'll catch up with Ollie Krug, and we'll speak to Norman Roule of CSIS on Israel's limited attack against Iran. From New York, this is Bloomberg. Snapping a 6-week winning streak on the S&P 500 last week. Equity futures looking to bounce back on the S&P, up by 0.6. On the Nasdaq 100, up by 0.75% this week. Basically, all the big tech players reporting earnings with the exception of Nvidia. That comes in about a month from now. The small caps up by 0.7%. Going into the jobs report on Friday, the median estimate is 110. The estimates are all over the place. This is going to be a noisy one. RBC at the high end looking for 164. Bloomberg Economics looking for negative 10K. If we get a negative 10K, what do we do with that? Just look through it? Buy the bond market? I don't know. Check out fixed income this morning. 2-year, 10-year, 30-year. The 2-year yield back to 4.11. Up half a basis point this morning, up 2 1/10s to 425.80. And Lisa, that would be my question on Friday morning. If you get a really soft print, is this market going to look through it or not?
It depends on what the unemployment rate is. A lot of people saying there's going to be even more emphasis on the unemployment rate as a proportion of what this labor market distortion might be. This is going to be messy data. A lot of people are looking through it. Fed officials themselves have said, well, it's the totality of data and are looking at other things. I would argue that tomorrow's JOLTS data, the job openings report and the quits numbers are going to have outsized influence on just how we look at the employment report that we get on Friday.
Brett Ryan at Deutsche Bank said exactly the same thing. Brett Ryan going into the weekend was talking about that being the last clean data point for the month of September, because this one's a little bit dated before you went into this mess through October.
That's the reason why I think that people are looking at that. People are looking at the beige book. People are looking at earnings reports and some of the tones out of the C-suite as sort of guiding how to view just how messy this report is, because everybody knows that it's got a lot of hair on it.
Also looking at this morning, the commodity market, crude is lower by 6% on Brent, on WTI by more than that. Brent crude's down to 71.52. WTI, Anne-Marie, down to 67.36.
This is a new normal. Can you imagine any other time if we weren't living through this cycle of violence and conflict in the Middle East, where Israel would have a direct attack on Iran and you would see oil prices pull back? But the fact of the matter is the market was potentially baking in Israel hitting oil infrastructure or even hitting nuclear infrastructure, which would have been a massive spike. You've taken that risk out, at least in the short term, and you see a pullback.
Norman Roule coming up a little bit later on this story. WTI 67.33. We've got some breaking news out of Volkswagen in Germany. Let's cross over to Bloomberg's Ollie Krug out of Berlin. Ollie, what's the latest this morning?
Yeah, so Jonathan, we've been talking about the woes of the manufacturing and the German sort of auto industry for a long period of time. What we got today is the proposal for Volkswagen, the brand Volkswagen. These are the cars with the actual VW print on the front, not the whole group. What they're actually intending to do about it, what sort of cost-cutting measures they are going to roll out. And John, they are absolutely huge. We're talking about cost savings of about 4 billion euros. We're talking about blanket cuts of pay of workers at Volkswagen by 10% across the board. We're also talking about the closing of 3 factories. That is what they plan to do at the management level. This is a company that has never in its history once closed a factory in Europe. We're talking about closing 3 in its home country right now of Germany, potentially 1 in Belgium as well. And of course, this will mean potentially tens of thousands of job cuts. So again, just to reiterate, Volkswagen talking about closing 3 German factories for the very first time in its 90-year history in Germany.
Ollie, it's not just VW. It's the other big players in Europe as well that are facing the very same issues. And Ollie, I wonder this morning whether this is really the start of a much bigger negotiation with the German government. Get your act together, provide some state aid, or this is going to happen and happen pretty soon.
I mean, completely, John. I mean, I just interviewed the CEO of Bosch earlier this morning. He was in the Berlin studio. This is the biggest supplier to the automotive sector. And what we heard from him is what we've heard from a number of executives in this industry. What they need to do is not be so focused on the supply side. They need to stimulate the demand side of this equation. And this is something that is going to come home to roost in a very, very real way. Because we've been talking about contraction in Germany for 2 years on PMI charts and all these sorts of things. The reality of what is happening is now going to go from the PMI charts, from the balance sheets to the kitchen tables. And again, tens of thousands of jobs. Volkswagen employs 300,000 people in Germany. That is going to have a huge economic consequence, to say nothing, Jonathan, of the political consequence that will also emanate from this in terms of where voters are going to feel and what they're going to vote for.
That said, Ollie, it seems like the German society has this entrenched feeling of not becoming indebted, of not being too fiscally, quote, irresponsible, of not spending too much. And that was the tone that we've been hearing out of executives, from the president to going down the pike to the central bankers. So have we heard any signs that you could potentially get a shift?
Alas, I think not. What we've heard from at least 2/3 of the governing coalition, from Olaf Scholz and the Greens, they have actually been talking for a long time about having to reform this debt brake, which is part of the German constitution. In order to change it, you need 2/3 of parliament. It's a really big thing in order to be able to affect it, and that is basically what constrains them on borrowing. The problem that you have is you have the FDP, you have Christian Lindner, the finance minister, who still holds the finance ministry, has said no way. For the CDU, now the opposition, likely to be elected next year in the elections, they have never going to budge on this issue. The question is, will the severity become so large that they will be forced to do something? Just to remind everybody, they did manage to make some of these some exceptions when it came to COVID, when it came to defense, and do some special funding. But this is really sort of the reality when it hits the road starting next year, and the potential strikes now at these sites that we might get as a consequence of these bargainings. I think things may have to change.
Well, Oliver, aren't we going to get strikes at least for an hour today at some of these plants?
Yeah, and again, just to bring this, the reason that they're now working on the assembly line for this hour, there is across all 10 VW plants in Germany right now, the workers have walked away, not to strike, but to listen to what the workers' councils are telling them about what management is trying to do. And she just delivered this information that we've just been given: 10% pay cuts across the board, potentially closing and putting all of their jobs at risk. So this is what they're looking at. This is important because obviously now all of those people will go home with that fear of potentially losing the job, but also the reality that this could be a taste of what is still to come. They have warned already that they could do warning strikes as early as the 1st of December.
Ollie, appreciate the update, sir. Ollie Crook out of Berlin on the latest with VW. Ollie framed it perfectly, supply versus demand. So let's start with the supply side of the equation for these automakers. This came from the team here at Bloomberg News, analysing some of the data on the continent. Nearly a third of major passenger car plants from Europe's 5 largest automakers were underutilised last year, producing fewer than half the vehicles they have the capacity to make. The threat is to reduce capacity. The solution, as Ollie suggested, that they're looking for is something to basically trigger demand. Do something to incentivise purchases across the continent, because if you don't, we're going to be cutting pretty fast.
The timeline, I think, is of import, too. When we talk to the executives, say, of Stellantis, they say this needs to happen now, or else they have to start cutting plants now because they are losing money. And so you have to wonder how willing some of the leadership, whether the chancellor or whether the parliament, can really get together and come up with something quickly enough to stave off some of these plant closures that we might otherwise see.
That's the latest on VW this morning. Here's the latest on crude oil tumbling following Israel's limited attack on Iran, avoiding the country's production facilities over the weekend. The attack coming in response to Iran's missile attacks 3 weeks ago. Norman Roule, a former senior US intelligence official, joins us now for more. Norman, welcome back to the programme, sir. I heard a phrase this morning, and Anne-Marie said it again this morning. New normal. Do you get the sense that this is now the new normal? Just the tit for tat, the back and forth between Iran and Israel for the time being.
Good morning. We're going to see this as the new normal for months to come until Iran can be convinced to cease attacks on Israel, and Israel believes it has reset deterrence throughout the region.
Norm, what is going to be Iran's response? Although the administration thinks that this direct confrontation has been closed out, Iran is saying that they are going to respond.
Yes, several of Iran's leaders have stated that they are considering what sort of response they need to undertake, but Iran needs to undertake 3 actual steps simultaneously. First, they've got to determine what exactly has happened in their country, what defenses are left, what does this mean in terms of their offensive capability. The Israeli attacks did very little that we can tell to stop Iran from conducting multiple missile strikes in the future, but nonetheless, Iran's air defenses have been so severely hit that Israel's counterattack could be severe. At the same time, Iran must undertake a diplomatic offensive, which it's doing at the United Nations with Europe, in essence to say, we're trying to be reasonable. You must pressure Israel to pull back. And they're not going to want to shift U.S. elections in a way that would make the United States more hostile. Last, Iran needs to support a ceasefire in Gaza and Lebanon. For Iran's pressure campaign in the long term to succeed, it needs its proxies in Gaza and Lebanon to survive.
Do you think if there was a ceasefire agreement, that it can end the direct hostilities between Israel and Iran?
In the short term, But the April attack by Iran on Israel, in essence, erased an important red line that neither country would attack the other directly. That red line is gone. And we've now seen several instances where Iran and Israel have struck the other. We are in a new normal where such strikes can become more routine. That doesn't mean each week, but it could mean several times a year. We also have to keep in mind that strikes don't necessarily have to be vast. They could be much smaller. Iran could launch a few missiles or a few drones to say, is this something Israel would respond to with a war? We are off the map in many ways.
You're right. There have been a number of red lines that have just absolutely evaporated over the course of the past year. Are there any red lines even left?
It's uncertain. It's likely that Iran's decision to build a nuclear weapon would be the last red line that needs to be erased. The challenge for Iran is that the United States and Israel, more importantly, seem to have exquisite intelligence about what's going on in Iran. And Israel has just demonstrated it has the capacity, the willingness, and the capability to conduct at will vast strikes against Iran's nuclear enterprise. So if you're Iran and you made a decision to build a nuclear weapon, the question you have to ask is, can you get away with it before Israeli missiles and aircraft destroy the facilities and the personnel involved with the program?
Norman, do you have any sense of whether this is sort of a medium-term tactic before setting the stage for something to happen after the election? That this was an effort not to really change the decks ahead of November 5th, but after that, well, the gloves are off.
Possibly, but it's unlikely. What Israel did was they moved up one rung on the escalatory ladder. They, in essence, said in April, we can touch you from the inside, leave us alone. Now they've said we can touch you at will in a number of locations. Please leave us alone. Depends upon what Iran undertakes. After an election, I'm not sure that Israel believes that either the Harris or a Trump administration would be interested in actions that Israel might take that would involve the United States in a long-term and expensive conflict in the Middle East.
So this could be possibly the end. Is that what you're saying? That essentially, if Israel neuters some of its adversaries, at least in the short term, that there could be some sort of deal, and that we are significantly closer now than we were, say, even 2 weeks ago? If
Iran does not attack, we could, and Israel believes it has reset deterrence with Iran, and it has strategically neutered Hezbollah and Hamas. We could be at a position where Israel might be willing to say, this is a victory of sorts, and allow ceasefire proposals to move forward and peacekeeping forces to move into southern Lebanon and into Gaza itself.
Norm, you mentioned the election, so I just want to end there. You said that you think either administration obviously would not be interested in being dragged into a long-term conflict in the Middle East. But there's reporting from the other day that former President Donald Trump apparently gave his support to Netanyahu in a phone call saying, basically, do what you need to do. Isn't that giving him the opening to basically start something bigger?
Not quite. I think it's more, should be interpreted more in terms of do what you need to do to end this problem. But that does not mean that the United States wishes to involve itself in a very costly and unpredictable conflict, which would have at first regional and then global economic and political consequences. But the Trump administration, based on its actions against Qasem Soleimani, is likely to support more robust actions by Israel against its adversaries.
Norm, you're one of the best. Appreciate your time again this morning. Norman Roule there, the former senior U.S. intelligence official over at CSIS. Crude this morning down by 5.7% on Brent crude. On WTI, we're down about 6 percentage points, 67.50 on WTI. With an update on stories elsewhere this morning with your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. McDonald's is bringing back the Quarter Pounder. The company said that the burger will return to menus at all restaurants this week. It has now ruled out beef patties as the source of an E. coli outbreak that sickened dozens and left one person dead. The infection appears to stem from the slivered onions on top of the hamburger. The company had stopped selling burgers in about 20% of its more than 13,000 restaurants in the U.S. They will return without the onions. Eli Lilly expects to start selling its highly popular weight loss drug in Hong Kong as early as the end of this year. Lilly's shot has already been approved in mainland China for weight loss and diabetes, but remains unclear when it plans to launch the product in the country. Its rival Novo Nordisk is already selling its diabetes drug in Hong Kong and mainland China, but its weight loss version has not been made available. And the World Series resumes tonight. Game 3 set for 8 p.m. Eastern in the Bronx. The Dodgers have a 2-0 lead. The blockbuster matchup has been a ratings hit so far. More than 14 million viewers on average. That is a 7-year high. The Yankees are hoping for a boost from star Aaron Judge, who has just one hit so far in the series. They're going to look to turn things around. Game 3, the next 3 games in New York City. And that's your brief, John.
Danny, thank you. Tickets on sale in the Bronx later on this afternoon. They're not ready, are they? Is Judge showing up a little bit later?
Well, we hope, but I would just like to note history's on the Yankees side. If you look at historically how they've played against the Dodgers and their series, the team that was up in the first 2 games of the series lost the series. Look at 1981, 1978.
You're far more hopeful than I thought you would be. I thought we'd be having a moment of silence this morning for the Yankees.
I thought we were going to talk about British football.
You wanted to do British football?
Yeah, I don't understand why we're talking about this.
I thought you'd want to talk about the Yankees losing over the weekend.
You know, it's okay.
All
I
right.
just moved on.
Up next on the programme, the bullish case. We're not going to do this anymore. The bullish case for the US dollar.
It's quite clear to me the dollar has to keep rising. If Donald Trump wins this election and you didn't hedge for it in your book, your boss will tap you on the shoulder and say, what were you doing?
Chill out.
That conversation up next, live from New York City this morning. Good morning. Live from New York, welcome to the program. Equity futures right now on the S&P positive by 0.6%. A little bit of a bounce across the board. On the S&P, the Nasdaq and the Russell. In the bond market, yields are higher by 2 basis points, 426. What didn't happen over the weekend? No strikes on energy facilities in Iran. Crude lower by almost 6%. WTI 67.53. Now the surveillance this morning, the bullish case for the US dollar.
Into the election, it's quite clear to me the dollar has to keep rising for 3 reasons. One is the swing states are moving in Trump's favor. 2 is you've got the data surprises in the US are pretty healthy. And 3rd is it's that tap on the shoulder moment. If Donald Trump wins this election and you didn't hedge for it in your book, your boss will tap you on the shoulder and say, what were you doing? The dollar continues to strengthen. We're looking for 157 in dollar yen, 103 in euro, for example, if that was to happen.
So here's the latest. The dollar strengthening heading into the final week of the US election as traders weigh the economic impact of both candidates. Mark McCormick of TD writing, we have painted the election as a binary event with massive tail risks on either side. The data currently favours the dollar regardless of who wins, suggesting to buy dollar dips into 2025, even if Harris wins. Mark joins us now for more. Mark, welcome to the programme. Let's just look ahead to next week. Give us the best case outcome for the US dollar and give us the worst case outcome for the US dollar. Which one's which?
Well, like I said, it's a binary event with like 2 large tail risks on either side. So obviously the most bullish for the dollar is a red wave, largely again because number one, you get tariffs immediately on day one as soon as Trump takes over. The second thing is you can have fiscal support and deregulation and all the things that are great ingredients that are cocktails for outperformance in U.S. equities. And I'd say on the other side, the thing that kind of confuses the market the most, or is probably the most bearish for the dollar, is a blue wave, but it's probably the most unlikely scenario. Betting markets have it about 10%, largely, again, because what you could do is you undermine the equity market. I think the most important thing to think about for this election is the number one thing that's been driving the currency market is not rate differentials, it's equity market performance.
With that in mind then, Mark, what do you think is actually outperforming already and pricing in the election outcome? Because a lot of people in the equity market are looking to financials and saying that maybe that's a lean to a Trump win. And maybe that's overdone, and maybe we get a reversal of that through next week. Do you see any sign of that taking place in FX with that in mind?
Well, I think one component, it's been really interesting. We talked about this a lot this entire year. There's really no macro theme that's driving markets. Like for the first start of the year, we talked about inflation. Then we talked about growth. Now we're talking about inflation again, probably because we forgot to talk about inflation for a little while. So the number one factor that we see that is kind of underscoring what's driving market performance is mean reversion expressed through positioning. So I would highlight that through the move that we saw recently in the dollar was basically short on our positioning models. So we had a perfect storm of U.S. data outperforming the rest of the world, which has actually been happening through most of the summer, but the market's woken up to it. We've also seen, again, the Fed took a huge risk by cutting 50 basis points. And now we're starting to see that backlash a little bit. And also, again, the positioning was built into a single narrative, which was only about the slowdown in the U.S. economy. And now all these things have come back to markets. They were positioned incorrectly. Data dependence leaves us, again, very focused on a month or 6 weeks of data that basically in turn catches markets off guard when the pendulum swings too far in the other direction. So I think a big piece of this right now is that the dollar looks fundamentally positive. Data is doing better than what we're seeing in Europe and China. And I know markets are like very focused on the China stimulus package, but to me, the China stimulus package is a second half of 2025 story that things are going to get worse before they get better. So again, the key theme here is that the macro situation is evolving into what is a more bullish fundamental story for the dollar, regardless of who wins.
Some people who are skeptical of the dollar point to gold, and they say gold's been a moonshot because people are worried about the dollar and worried about the idea of people having faith that this truly can be the reserve currency, not necessarily next year or the year after, but say in 10, 20 years. Do you look at gold, given the fact that it's almost doubled in price since the beginning of over the past 5 years? If you take a look at that, does that make you at all concerned about this dollar call?
It doesn't. I think what's interesting is, again, you have to think about, like, what are the assets that people want to hold in an environment where there's geopolitical uncertainty. We're dealing with, in my opinion, structurally higher inflation than what we saw before the pandemic. In a world where, what are your bigger risks towards a recession or higher inflation? And I think in that environment, like, more people are focused on hard assets, and those hard assets provide a decent hedge relative to, say, fixed income. So I think if you were to think about what's my asset allocation mix, it's still you want to be long U.S. equities, which gives you an exposure to the U.S. dollar. If you think about even an asset allocation mix, what we talked about in our election piece for next year is, yes, Asia has the ability to grow their economy. They have savings that they've exported to the rest of the world. Europe does not have the ability to grow its economy. As we talked about this morning, I've heard in prior pieces, but like France is spending too much, Germany doesn't spend enough. And again, if you think about the Draghi report, everything that's been coming out of Europe is focused on the industrial audio sector, which is something that there's a reason why there's tariffs being put in these sectors. And there's a reason why China is the world's largest exporter of automobiles right now. So if you think about the growth in the equity and all these stories, the U.S. equity market still offers probably the best risk-adjusted performance relative to other classes. We could see a rotation to Asian equities where currencies are undervalued, but that still leaves Europe somewhere far behind everywhere else. And gold is still an asset that you want to hold on to, because what we're seeing is coordinated fiscal and monetary policy with inflation above target.
Mark, we've got to leave it there. Appreciate it, sir. Just got some breaking news on Boeing here. Mark McCormick there of TD. The latest on Boeing, launching a nearly $19 billion share sale meant to address the troubled plane maker's liquidity needs and stave off a potential credit rating downgrade to junk. The latest reporting from the team led by Julie Johnson this morning.
Yeah, 90 million common shares and about $5 billion of depository shares. It would be used for general corporate purposes. Basically, this would be about just under $19 billion based on the share price of close on Friday of $155. A real question here, as we parse through this, about how much liquidity they're raising and what they're giving to try to raise this at a decent term.
The stock is already down by more than 40% so far this year. We're down another third of 1% in the pre-market. We'll come back to that story a little bit later this morning. Up next on the programme, we'll catch up with Victoria Fernandez of Crossmark, Henrietta Treyz of Veda Partners. We'll speak to Tom Narayan of RBC with the latest news out of VW, a real threat to close down plants, cut workers and offer pay decreases as well. And then we'll catch up with the Nobel Laureate Joseph Stiglitz endorsing, guess who? The Vice President, Kamala Harris. Plenty of thoughts on that, and we'll get his thoughts on why he believes she has the better economic plan. In the bond market right now, bond yields just a little bit higher, up a single basis point at a 10-year, 4.25 on twos, 4.11. Huge week ahead, massive week for tech earnings, payrolls just a few days away. From New York, the second hour of Bloomberg Surveillance, up next.
This economy is actually performing better than expectations. There's reason to suspect that there's a lot more runway for growth than people had been anticipating.
We are simply growing better. Look at the recent IMF revisions. U.S. up in terms of growth rate.
There is a bit of a disconnect, I think, with a lot of the data points that have been coming out.
We know it's potentially an important inflection point, depending on which way U.S. policy goes in many areas.
At the moment, we're sitting at a place where The soft landing has happened, and the Fed is incentivized to keep it going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now as we come into Monday after snapping a 6-week winning streak on the S&P 500, the first weekly loss in the last 7. Equity futures on the S&P 500 bouncing back on the Nasdaq as well. On the Nasdaq 100 up by 0.6, on the S&P 500 up by 0.5. This is often our favorite week of the quarter, the favorite week of earnings season. Just look at these numbers that we're going to see from these names. Google, Meta, Microsoft, Apple, Amazon, all coming up through this week after we saw Tesla kick off the Mag 7 with some phenomenal numbers. That name was up by more than 20% in a single trading day. Then if that wasn't enough, we've got this for you as well. A week packed, a shed load of economic data, climaxing with payrolls on Friday. I've been through the estimates a few times. I think it's worth doing so again. We've nudged down, inched down as we get more survey estimates. 110 is the median now. 164 is the high, and I think I hate going back to this for a reason. Anna Wong over at Bloomberg Economics, who we'll speak to in about 1 hour and 45 minutes, looking for negative 10K over at Bloomberg Economics.
It's going to be messy because we have the hurricane influence as well as the strike influence, which is the reason why you asked the right question. How's the bond market going to respond to a downside surprise? And could the potential bigger surprise be upside? And really, ultimately, a lot of people are looking at both the unemployment rate within the internals of that data to try to understand a little bit of a cleaner read, and the JOLTS report coming out tomorrow to truly understand the last, as you said, clean reading of economic data before that employment report.
Since that September report, we've seen the Treasury yields climb, and everyone on this program last week said the bigger surprise will be to the upside because everyone's already going in with it baked in being a low, maybe not as low as negative 10, what Bloomberg Economics has, but everyone thinks it's going to be low because of Boeing is still on strike, entering its 7th week. You have the hurricane impacts as well. Everyone expecting a weak data payroll report. What happens if it's not weak?
Deutsche Bank looking for 100K. That's their estimate. Within that, the striking workers, that reflects a 44K drag from striking workers, 33K of which were, guess who? Boeing. Let's talk about Boeing in the pre-market right now, softer by just 0.1%. Is this your kitchen sink moment for this name? Launching a nearly $19 billion share sale, Lisa, to address liquidity needs and prevent what they've been trying to prevent for the last few months now, a credit rating downgrade.
The news just dropped. I'm trying to parse through the details. Honestly, I have no idea. It's very unclear to me, exactly how much they're going to raise and whether this is going to be what they need, the injection, to really stave off that downgrade to a junk rating. It's clear they need to survive. It's clear they need to do a lot of structural changes to their business. Is this just buying time before they can get another agreement? That's also going to make a difference. Can they get people back into the doors to work?
And build some planes. We'll come back to that story a little bit later this morning. Futures backing off just a touch. We're up by 0.4% on the S&P. Worth talking about this bond market move. Yields higher by a single basis point, 425.20 on a US 10-year this morning. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark as stocks look to bounce back from last week's sell-off. Henrietta Treyz of Veda Partners with just over 1 week to go until Election Day. And Tom Narayan of RBC wrapping up earnings from the automakers. We begin this hour with stocks looking to rebound from their first down week in 7 as investors look ahead to the payrolls report and quarterly results from mega-cap tech. Victoria Fernandez of Crossmark Global Investments writing, "We don't want to stand in the way of the forward momentum these reports represent. But we can see warning signs that say slowing down is possible." Victoria joins us now for more. Victoria, welcome to the show. Let's get straight to it. Warning signs that things are slowing down. What are those signs?
Yeah, Jonathan, I think most of that is going to be coming from the labor market. And we know that the Fed is really focused on the labor market right now. And so I think it holds even more potential there to drive the markets. So JOLTS report tomorrow, I think, is going to be key. It's going to tell us what hiring looks like. We know hiring has basically been frozen. Temporary jobs have been coming down. The labor differential, which we all have talked about before, is widening, and that's quite negative. You look at small businesses, the NFIB report that came out, and they're saying, look, we're not going to be investing, so CapEx is going to be coming down. We're seeing a skill set mismatch right now, so it's hard to find the labor that we need. They see revenue coming down, and we're seeing that in earnings across the board. Beating on revenue has been very slim for some of these companies, yet they're able to come in and beat on the bottom line. So revenue is a concern, which means margins are a concern, and they're losing their pricing power. So I think there's a lot of elements here that are affecting businesses, that are affecting consumers. And with a consumer-driven economy, I think we have to be concerned that a slowdown could be coming.
So, Victoria, hiring is down, quits are down, anxiety is up. You mentioned the labour market differential. You're starting to see that impact economic outcomes to a degree. I certainly don't see it in retail sales, but you say you're starting to see it in top-line revenue growth. Is that a reason to back away from consumer-facing companies?
I think you have to be cautious when you're looking at these consumer-facing companies. There's some that have very strong balance sheets that are going to do well here in this holiday shopping season. And so I think you can still have some exposure there. But I do think you have to take a step back and say, where are you probably going to see people pull back the most? We know high-end consumers are the one that are really holding up this economy, and they've pulled back from the more luxury items. We've seen it in LVMH, we've seen it in Hermes, we've seen it in other names. They're moving into medium income level stores that typically are not their go-to places. It's a perfect reason why Walmart has done so well, is because you've had higher income consumers move and become more their customers. So yes, I think you have to be careful when you're looking at retail, but look, surveys are saying the consumer is going to spend 8% more this holiday season than they did last season, which is kind of hard to understand when they're struggling. But at the same time, Jonathan, NerdWallet came out and said 28% of holiday shoppers have not even paid off their gifts from last year. It puts a real question mark on how strong the consumer is going to be heading into the new year.
And just the American culture that has supported a lot of this recovery and, frankly, the strength that we've seen. Victoria, I'm curious what this means for you. It doesn't sound like you're willing to pull all equity investments or anything of the like and go into gold and hide. But I wonder if we're starting to see the change in leadership once back to the idea of Magnificent Seven leading once again. In other words, are we seeing the death of the very brief rotation out of Mag 7 into the 493 others?
Yeah, I'm not sure we're seeing the death, Lisa, but look, this week we know we've got 5 of the Mag 7 reporting. As you guys mentioned a minute ago, Tesla reported and knocked it out of the park. So are those names going to take leadership probably here in the short to intermediate term? Yes, I think they will. I think they will be driving the markets, whether it's positive or negative, depending on earnings here. But if you look at some of the sectors, financials continue to outperform on a relative basis. You've got, for the financial sector as a whole, over 90% of those names making 52-week highs right now. You look at tech, that number is way down from there. That number is closer to 52%, and semis are even lower than that. So I still think you have financials, you have industrials that are leading, but could we see some short-term shifts this week, especially with the earnings we have? I think we absolutely can.
Victoria, how difficult is it understanding some of the leadership right now? In other words, with respect to financials, how much is that some issue with the election and the leadership in the race, Donald Trump potentially winning, versus the increase in yields, stronger performance, better than expected economic data that is surprised to the upside?
Yeah, you normally see financials perform better following the election. So you do have to wonder, if you look at 2016 and use that as a guide, is some of that being pulled forward right now? And so financials are doing really well, but we're going to see that taper off. We just don't know. I mean, yields are moving higher at the same time that the equity market in general is moving higher. I know this last week we had a pullback, but the trend is still higher, which tells us the market's being led by growth. So where are those inflation scares? They're not there as much anymore. But I think where you are going to see scares is in regards to debt, in regard to Treasury issuance. We have the refunding announcements this week. Let's watch those carefully. You typically have yields move higher about 6 to 8 weeks following the first rate cut, and then they start to fall again. So let's watch and see how yields behave. And if we start to have any kind of effect on the equity market as we get maybe 4.25, 430, 430 is that resistance level right now that people are watching.
So Victoria, you basically saying what we're seeing right now play out in financial markets is dependent on data, not on the betting markets, which are pricing in potentially not just Trump back in the White House, but a Republican sweep.
I do think, Anne-Marie, that the market is saying, look, regardless of who wins, we are going to probably get higher inflation because we're going to have continued spending. I don't hear anyone talking about any kind of cutting and cost. And so therefore, we're going to see inflation move higher, the debt move higher. So yields, I think, are moving higher based on the election, not just because a Trump win is being priced in a little bit more. I think it sees it regardless of who wins. I also think, though, we're seeing some of the Fed cuts priced out of the market, and the city surprise index, which has a high correlation with yields, moving higher as well. All of those are pushing yields higher. It's not just the election, but I think there's definitely a concern in regards to debt and Treasury issuance going forward.
We have a lot of different events this week and next week that are really going to be important for the market. What are you most focused on?
Obviously, the earnings that are coming this week, these are large companies. We know that they've been driving the market for years, so we really want to watch and see how they're going to perform. So that's really important. But one of my favorite things is the JOLTS report, and we've talked about it before. I know everyone watches the payroll numbers, but y'all were talking about how that's going to be affected by a lot of the weather items that we've had as of late. So let's look at that JOLT. Are we seeing hiring continue to fall? Are we seeing the job mismatch still there? Are we seeing openings come down? These are the things that I think will give us a little bit of insight into the underlying drivers of this market, which is the consumer.
That data comes tomorrow. Victoria, we'll leave it there. It's good to catch up. It's good to see you. Victoria Fernandez there of Crossmark Global Investors. If you are just joining us, welcome to the programme. Equity futures near session highs, up 0.5% on the S&P 500. Let's give you an update on stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just some more details on that Boeing breaking news. They are announcing a nearly $19 billion share sale. It offered to sell 90 million common shares and $5 billion of depository shares. The offering confirmed earlier reporting by Bloomberg and is meant to address Boeing's liquidity needs and prevent a credit downgrade to junk. The capital infusion is necessary to fund its production ramp up once a now 7-week ongoing strike ends. London's workforce is expected to remain below pre-COVID levels. The city is still grappling with the workforce that prefers remote work. Job vacancies in London are stuck at around 25% below 2019 rates. It's been an issue for the hospitality sector. Fewer workers are buying coffee and pints after work. Demand for workers out of London, though, that remains robust. All other UK regions are seeing new jobs at or even surpassing pre-COVID levels. Rapper Bad Bunny has thrown his support behind Kamala Harris. The Latino superstar shared a video of the vice president with his 45 million followers on Instagram after a comedian at Donald Trump's rally at Madison Square Garden called Puerto Rico a floating island of garbage. The comment drew backlash from many, including Florida Senator Rick Scott. A Trump advisor has distanced the campaign from the joke, saying it does not reflect the views of President Trump. That's your Bloomberg brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. I imagine the person responsible for booking Tony Hinchcliffe to be the opening act of Madison Square Garden for Donald Trump's in a lot of trouble this morning.
Well, Ambassador McMullen says now he's the most famous person, and it took away from the event, quite frankly, and could have some serious damage. There are nearly 600,000 Latino votes, eligible voters in Pennsylvania. Half of them are from Puerto Rican descent.
Not the headline that campaign wanted this morning. Up next on the program, 8 days until Election Day.
For the past 9 years, we have been fighting against the most sinister and corrupt forces on earth. With your vote in this election, you can show them once and for all that this nation does not belong to them.
That conversation up next, live from New York. This is Bloomberg. Equity futures this morning up by 0.5% on the S&P 500. Here's a snapshot of things cross-asset. Yields are higher by a single basis point. The 10-year 425.20. In the commodity market, we're down by almost 6% on WTI, 67.58. Under surveillance this morning, 8 days until Election Day.
For the past 9 years, we have been fighting against the most sinister and corrupt forces on earth. With your vote in this election, you can show them once and for all that this nation does not belong to them.
And I'm going to tell you, as I travel around our country, there is an overwhelming call for a fresh start. For a new generation of leadership that is optimistic and excited about what we can do together.
So here's the latest. Donald Trump and Kamala Harris taking the fight for the White House outside the swing states. We're just over a week until Election Day. Bloomberg reporting more registered Republicans have already voted in Arizona, Nevada and North Carolina. They're Democrats. Henrietta Treyz of Veda Partners writing, it is distinctly possible that a victor is named in the 2024 election by Wednesday. If not, the worst-case scenario pandemic year-level disruption suggests developments could come through Friday and possibly Saturday, as was the case in 2020. Henrietta joins us now for more. So, Henrietta, let's get to your base case. Do we get a 2016 or a 2020?
I think we're looking more at 2016. I think a lot of the disparities, discrepancies, any concerns at the local and county level amongst the electors, they're fully staffed. They have gone through the 2022 midterm elections. They've gone through all these lawsuits. I think all the T's are crossed and the I's are dotted, and we will have an outcome on Wednesday. I'm optimistic.
Henrietta, but what do you make of Maricopa County election officials saying it could take anywhere from 10 to 13 days?
Yeah, I mean, they're definitely preparing us for the worst, but I believe Arizona and Nevada in particular were uniquely sort of embarrassed by the way the 2020 election took so long to call. And a lot of that disruption came from the occupant of the White House. So I think that this time around, they will be very diligent and careful about how they're reporting. And then hopefully we won't have to depend on just one state to decide or to know who wins the election. Maybe in the House, for sure. I think it'll take all week to get a solution. But I'm hopeful that the rest of the country will give us a decisive solution.
A theme that I've been hearing from sources a lot on both sides, that Democrats are actually running a very good ground game, especially in these swing states. But you're actually seeing, and so are we, a lot of Republicans are going out and voting early. Are they catching up to that ground game?
It's the ground game right now, and the pull forward vote is incredible. In a number of states, including Nevada, there are double the amount of Election Day Republicans from 2020 voting early this cycle. So this message that you saw on the big Jumbotron at MSG last night was vote early. The Republican Party across various swing states, including Pennsylvania and Georgia as well, have spent millions of dollars trying to educate their voters to vote early, vote in person. Democrats still predominantly vote early in mail-in ballots. So we're waiting for that data, for example, out of Clark County in Nevada to catch up. But what we're going to need and what Democrats will need going forward is to see what the turnout is on Election Day. And in particular this week, this is a week where a lot of the younger voters turn out early if they're going to vote. Mostly right now, it's rural, white, older voters who are turning out, which is a disproportionately Republican demographic.
Henrietta, we know that once you go out and vote early, then whether you're Kamala Harris or Donald Trump, you could focus on some of those margins potentially to get out then on Election Day. And you say this all comes down to the suburbs. Who wins the suburbs?
Yeah, that is the game. In 2016, Hillary Clinton lost the suburbs. And I think it was only by about 2 points, but it was enough to lose the entire election. This is your suburbs outside of Philadelphia, outside of Pittsburgh, key portions of Michigan and Wisconsin. In 2020, Joe Biden narrowly won them back, again, by, I think, 2 points. So he was able to claw back those suburban voters. Kamala Harris currently leads nationally with suburban voters by 6 points. So we spend a lot of time talking about the youth Latino and youth male vote. Obviously, they'll be but a part of the conversation is we're talking about Puerto Rico being a floating pile of garbage and things like that. But that is what turns off the suburban married voter, and they disproportionately vote in elections, and they have been the clincher for either candidate in the last 2 cycles and probably will be again in this 3rd cycle. They're voting more than they did in 2020, while cities and urban dwellers are voting less and rural voters are voting more than they did in 2020. So it's the suburban vote that is integral and critical to this election right now.
So if you push that forward, Henrietta, are you saying that Kamala Harris has more support than the polls are giving her?
Kamala Harris has more support with voters who matter more, again, because they vote more. They're a larger demographic, and they are the ones that are persuadable more than anything else. You know, you've lost the cities, that those voters are going to Democrats, and you've lost the rurals. Those voters are going hard to Donald Trump. It's the voters in the middle and suburbia that are swinging back and forth between 2016 being pro-Trump and then 2020 decided they didn't like what they had gotten for the last 4 years. And now under Kamala Harris running at the top of the ticket, they have swung pretty substantially in her direction and away from Donald Trump. And their turnout is what's going to be the biggest bang for your buck population-wise to flip these states.
It's pretty controversial, Henrietta, what you're saying, based on the polling that we've seen and just sort of the momentum and what we've seen in betting markets, which have given Donald Trump the clear lead. Where are people wrong in their analysis? Is it just the suburban voter, or is there something else in terms of what the deciding factors really are?
Well, I spent all week last week with investors up in New York, and I would say that the street is even more bullish on Trump winning than the predictive markets are. Last I checked, predictive markets were at like 61% that Trump would win. I'd say on the street, it's more like 70%. So there is this high degree of conviction, and the early voting data out of Nevada is painting a very bleak picture for Democrats. So there's reason to be excited. Unfortunately, it's just too early to get fully on board the Trump train. And put your bets on the market right now in a way that suggests that there is no time for change. There is a whole another week of early voting in most states, and then obviously we have election day where turnout is going to be the name of the game. So I think that the street is picking up accurately on the state of Nevada, but that's not the story that the rest of the nation is telling us yet. It could be, but it's pretty early.
Henrietta, we spoke to a guest this morning that said for the business world, for the tech titans, the writing might be on the wall. Let's talk about some of the tech titans. After the assassination attempt on Donald Trump back in the summer, we had an interview. We spoke to the Meta CEO, Mark Zuckerberg, who referred to that as being badass. And then we saw Jeff Bezos' Washington Post over the weekend fail to endorse a candidate. Some people suggesting that maybe it's because Bezos was worried about an incoming Trump administration. And then we heard on the Rogan podcast that the Alphabet CEO had given the former president a call as well to congratulate him on his campaign event at McDonald's and what a hit it was on Google. What do you think that they sense is coming from the Republican leadership that might affect them?
That's a great question. I mean, you're going to have antitrust on the docket next year. We have a massive tax bill that we have to write. The tariffs are also going to be a concern. Not just that, but export control restrictions, inbound and outbound investment restrictions. I think all those pieces are really integral. But the reality is there's a $5 trillion tax bill that we're going to be writing next year. And all these corporations, particularly any that are multinational, have a lot of skin in the game on this one. So it makes sense to try to make sure you have bridges mended with everybody potentially that could win. I think there should be a lot of focus on the House members and the House races. Those are pretty predominantly in coastal states this year. So New York and California. If I were those tech titans and I was trying to really influence the outcome of the election, I'd focus on the House members just as much as the White House.
Henrietta, appreciate your views and your perspective. The analysis there from Henrietta Treyz of Veda Partners. That last note, that final note, and what's happening with some of the big tech players across this country.
And you have to think that not just Mark Zuckerberg came out and said it was badass. I believe that was the only tweet that Jeff Bezos sent this year was following that first assassination attempt on the former president's life. And then coming out this weekend, there's been a lot of criticism about the Washington Post not going through with their endorsement on the editorial side.
How much is the fear of retribution? And what could they potentially do? And I think you asked the right question, which is what's on the docket? Is it the potential of Lena Khan being there still and being more aggressive, as we've heard J.D. Vance talk about? Or is it just they don't want to be in the crosshairs of being called, all sorts of names and castigated as biased, because that really undermines a lot of consumer confidence that they've already seen during his previous administration?
Learning a thing or two from Tim Cook over at Apple, maybe, as some of the other tech firms. Up next on this programme, Tom Narayan of RBC, as we look ahead to Ford earnings after the closing bell and look back to some pretty concerning news out of VW from earlier this morning. From New York, this is Bloomberg. Equity futures on the S&P up by 0.5% on the S&P 500 this morning. Last week, only one positive session in the whole week on the S&P. We're looking to bounce back from the first week of losses out of the last 7. On the Nasdaq 100 up by 0.6. Tons of earnings through the week, including 5 of the Mag 7. In the bond market, the 2-year and 10-year up by double-digit basis points through last week. The 10-year 411. The 10-year 426 up 2 basis points this morning at 425.80. Lisa, as you pointed out, it's not just the economic data, some real issues as well, some supply side stories.
Yeah, basically you're going to get a slew of issuance. It's actually front loaded because of the calendar. So you get some close to $140 billion of notes today, 2-year and 5-year. And then tomorrow we get $44 billion of 7-year notes. Just a question of how much this is really risk aversion, how much this is actually a bullish feel on the U.S. economy, and how much this has to do with the deficit. Right now it's unclear. But to me, I think it's notable that last week we saw the biggest underperformance of the Russell 2000 going back to July at the same time that the 10-year yield, guess what, hit the highest level going back to, guess what, July of this year.
Yields creeping higher again this morning, 410.75 at the front end of the curve. Switch up the board, turn a page and get to the foreign exchange story. Dollar yen. Dollar yen over the last few weeks, climbing for 4 weeks, the longest run since April, and up again this morning at 152.67, up 0.25%. An election story over the weekend.
Yeah, Prime Minister Ishiba held this snap poll. Basically, they had come under a lot of fire. His Liberal Democratic Party, which had been the preeminent party ruling over Japan going back to the 1950s, he lost. He lost a majority for the first time in Parliament since 2009. And now the question is, could his leadership be disrupted enough that someone else gets in who wants to emphasize some sort of fiscal expansion on a much greater scale that would prevent them from hiking rates further? So that, I think, is the fear that you're seeing expressed in a much weaker yen.
Even if he's able to stay on, he's going to have a very weak coalition and a very weak government, and that is going to be very complicating for the Bank of Japan.
Dollar yen, 152.65. Under surveillance this morning, some top stories for you. Israel launching retaliatory strikes against Iran over the weekend, destroying several air defenses and damaging Iran's long-term ability to develop ballistic missiles. Iran's leaders emphasizing their right to respond, but not directly calling for retaliation. Off the back of this, crude getting hammered.
And this is why you have U.S. officials coming out and saying this is the end of this current retaliation tit for tat between Israel and Iran. So they say this direct exchange, this should close out that direct exchange. But you look at what Roule talks about, former U.S. intelligence official who did a lot of work regarding Iran. The fact that this is a new normal in the Middle East. How many red lines have been evaporated? So maybe this closes out the tit for tat for now. But where is this going in the future?
Yeah, the conflict in the Middle East isn't over. What a shocker, right? That never has ever been sort of concluded. But there is this question going forward of whether you've taken some of the hot war elements out, given the fact that certain strategic assets like the fuel to fuel ballistic missiles were taken out, as well as some of the air surveillance system that Iran has.
Down 6% on WTI, 67.54. Brent crude, 71.77. Shares of Boeing, just about unchanged in the pre-market. The company launching a nearly $19 billion share sale to address its liquidity needs and stave off a potential credit rating downgrade. Boeing shares are off by more than 40% so far this year. And a real conversation this morning after a share sale like that, potentially, of whether this really is the kitchen sink moment.
Kind of depends whether they can get workers to come back to the plants to actually make planes. If they can't do that, this is not going to be the last salvo.
Exactly. We're entering our 7th week. Until those workers come back, every analyst says they're just hemorrhaging cash, which is why they had to do this in the first place. It's not even really working for their stock this morning, which was a little bit weaker and I guess now unchanged. Down 40% of the year. They're even talking about this possibility of options for the Starliner, something that is a storied part of Boeing and also America in terms of getting to space and NASA. This feels like they are reaching the bottom.
That's the latest on Boeing, and this is the latest on VW. Volkswagen seeking to close at least 3 plants in Germany and downsize all remaining sites. The company aiming to cut monthly salaries of all employees by 10% and divest entire departments and divisions, with outsourcing to other service providers and moving work abroad. That name is down about 0.7 this morning.
Yeah, right now I'm looking at VW's response in an emailed statement saying that some plants are double as expensive as competition, saying that German factory costs 25% to 50% over target. And they're talking about the need for some sort of comprehensive solution. But I'm looking at this and I'm thinking, you raise this. Is this a negotiating tool? How much time do they have before they start doing mass closures? And is this going to be the norm? Is this the only solution at a time where policymakers really haven't weighed in with any kind of comprehensive solution or willingness to expand the purse strings?
So unfortunately for VW, this is not straightforward. They might have the willingness to do this. They might not have the ability because the unions in Germany are so powerful. That's one issue. The second one is, I really do believe this is the part of an ongoing negotiation with the government that VW is not only conducting, but auto manufacturers are as well. Stellantis had this conversation directly with us just a week ago. Carlos Tavares came on the programme and basically said, we've got weeks, not months, to sort this out. Either you provide a demand-side incentive or we'll provide the supply-side solution. And that supply-side solution is going to be pretty painful for you politically as well.
Which it seems like it's sort of moving toward that. To your point, is this actually a negotiating tool? If they aren't getting any kind of response from the fiscal lawmakers, because what we're hearing, and frankly, last week, when I was speaking to the German Bundesbank head, you think, okay, they're flat on their back. They're actually having a contracting economy. They should be the ones arguing even more for rate cuts. But his argument was, well, we'll see. I don't know. It's actually not that bad. If you take a look, things are going to turn around shortly. Is that sort of the status quo in terms of how people feel, that it's going to get better? Just wait. Stop being so dramatic.
Sadly, German officials have had their head in the sand for much of the last decade. And you're seeing more evidence of that over the last few weeks. Let's talk about Ford. Also in focus this morning, reporting after the closing bell this afternoon, the automaker is trying to rein in warranty costs and lower electric vehicle losses. Tom Narayan of RBC saying Q3 consensus seemed achievable, but 24 guidance could be cut as a result of elevated dealer inventory levels. He has a sector perform rating and $10 price target on shares of Ford. And Tom joins us now for more. Tom, good morning. Fortunately, we've got to start over in Europe before we get over to the United States. How much of a supply-side issue do we have over there? How much capacity does need to be cut at these major manufacturers?
I think it's actually real. I think what VW is saying is more than just politics. I don't know if you guys noticed the Mercedes results yesterday. If you really look kind of in the details, you noticed that revenue per unit outside of China was down 8.5%. Are we at the beginning of a deflationary cycle? If Mercedes is feeling it, maybe VW and BMW, et cetera, are seeing it. Europe is not as healthy economically as the U.S., as you guys pointed out. So I actually think there's something to it what VW wants. I don't know if these OEMs really know what's going to happen next year, but when pricing falls, it drops 100% to the bottom line.
So what kind of cuts are you envisioning for the European players, for the big five? What are we thinking about? Tens of thousands of job losses, plant closures? How do you think about this?
Well, to your point, it's not as easy to do it, right? I think what they would rather, the OEMs would rather have, is stimulus come back, especially for BEVs, for EVs. They have that giant regulatory cliff next year, right? So that's ultimately what they want. If they don't get that, it's huge fines or paying Tesla for credits. So I actually think what will eventually happen is you will get subsidies will come back for EVs, especially in Germany. It'll be a mixture. They'll have to buy some credits, maybe pay a little fines. And yeah, I think you could see plant closures.
Okay, but how much time do they have? I mean, we heard that from Stellantis, that it's really, he needs to hear in the next couple of weeks or else he's going to see some really significant need to cut plants. I mean, is this a couple of week type of timeline?
It could be. I mean, that what we saw out of the Mercedes results last week, after they had already profit warned, is alarming, is concerning. Like, are we at the beginning of a big price deflationary cycle? Maybe they need to cut sooner. But remember, these guys also have big balance sheets they built during the pandemic. They are financially healthy. So could they withstand that? Possibly so. But it is scary. Once this starts happening, the price deflation, it can get pretty ugly.
Financially healthy and actually profitable. Two different things, right? And this response from VW, and I'm almost distracted by it, that some plants are double as expensive as competition. This is a direct commentary on how much cheaper it is to produce in China than it is in Europe. And a lot of those cars are going to be cheaper for the consumer at a time where inflation evidently is still a problem, enough for the ECB to mention it every single time despite some of the economic numbers. So at a certain point, isn't this a structural problem that even plant closings isn't going to change?
It could be. The big worry is obviously the Chinese OEMs enter Europe. What's going to happen? Fortunately, their salvo is this isn't really happening already. They have the tariffs. It'll take a while before the Chinese can Trojan horse into Europe. But when that happens, things could get pretty ugly.
Well, meanwhile, we're expecting Ford results after the bell, and there's a question of how much U.S. auto manufacturers are insulated from some of the same trends that we're seeing in European auto manufacturers. We saw results from GM, and they were pretty good. We saw Tesla knocked it out of the park, at least relative to expectations. How big of a disparity is there between the European auto manufacturers and the U.S. ones?
I think it's a big one. I think right now, where do you want to be, right? You want to be with U.S. exposure, absolutely. But I would differentiate Ford's situation from GM and Tesla's. I think there's a dynamic that's different. Remember what happened to Stellantis, right? They have this big dealer inventory problem in the U.S. Guess who has a higher dealer inventory problem than ended last month? Ford. So, and they, Explorer, Jeep Grand Cherokee, Bronco, Wrangler, like this is the sweet spot of competition. If Stellantis is starting to cut pricing, which we've already started seeing, take a look at Jeep Grand Cherokee pricing, that could go head on against Ford. I am worried about them in the next couple of months that they'll have to respond. You already have a high dealer inventory issue with Ford. So I think it's a very different situation from GM, who has a pretty healthy dealer inventory situation and who's really exposed to large SUVs, doesn't really compete as much against where this pain point is.
We know that Ford is cost cutting. We know that they're scaling back when it comes to the EV ambitions. But when will all of this mean they're actually turning it around?
It's going to take a while, right? Because they're at this weird point where they're still, losing money relative to ICEs, but the scale isn't there. So they're, in fact, if they were to sell a little more EVs, it would still lose relative to ICEs, but not as much as they are now, because they're just not selling enough EVs, and there's such a fixed cost base, and they're losing. So in a weird way, they need to sell more EVs, even though they're pivoting. So that's what we're expecting to see tonight. Like, will these EV losses decrease? I mean, we know the volumes, they already gave it. It's similar to last quarter, so I tend to think not. I actually think the losses will be similar.
But unlike Europe, the subsidies are here in the United States, and they're unlimited.
Yeah, but they're actually not getting, obviously, as much, right? They're still sourcing a lot of the battery infrastructure from China, et cetera. So you don't get as much of the credits as GM and as Tesla is getting. But the real issue is just the scale. They have two EVs, right? You have the Lightning and the Mach-E, and those are the sweet spot where the competition is already. The Model Y is right where the Mach-E is. Whereas GM has models that are new, the Equinox, Blazer, which cater to a different demo, and they're able to take advantage of the IRA and sell this car for less than 30 grand. It's actually the cheapest EV on the market, even cheaper than Tesla. Whereas for Ford, they can't get that advantage.
But not cheaper than BYD's under $10,000, which the Ford CEO called pretty damn good.
Right. But, I mean, well, can they sell those in the U.S. anytime soon? We'll see.
Just a final word, VW and the U.S. market. What do you make of this Scout comeback?
This is really interesting. And actually, most of the inbounds I've been getting have been about Rivian, how this relates to Rivian, obviously, like what's going on there. It is interesting, too. I cover both stocks, but usually you get a lot of fanfare from the corporates, from VW about something like this. Nothing. So I tend to think that this is a very independent strategy from VW. Let's invest in this. Let's also invest in Rivian. Let's see what happens. We want the U.S. badly. We want SUVs and pickups in the U.S. Let's see who wins.
Saw the Nostalgic ad campaign over the weekend. What do you make of the car?
I think it looks really nice.
I thought it looked pretty cool too. It's got that like old school Bronco vibe.
Ford Bronco, baby Bronco, yeah.
Yeah, without the sort of negative connotations attached to it. Tom, thank you, sir. Appreciate it, sir. Tom Narayan of RBC with an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. Royal Philips fell the most in 26 years, 18% decline. The medtech firm slashed its growth forecast, citing tepid demand in China. Its forecast is now 1.5% for the year. Earlier, Philips had said 5%. China's been cracking down on its healthcare sector with strict domestic requirements for many products. Philips CEO Roy Jacobs said that uncertainty in China will remain for the next few quarters. Former President Donald Trump held a nearly 6-hour rally at New York City's Madison Square Garden yesterday. Trump was joined on stage by roughly 24 speakers, including Elon Musk, celebrity wrestler Hulk Hogan, and House Speaker Mike Johnson. The rally featured criticisms of Vice President Kamala Harris over the border, crime, and the economy. It also included a comedian who made off-color jokes about Latinos and called Puerto Rico a floating island of garbage. Dodgers superstar Shohei Ohtani is expected to play in tonight's World Series game after partially dislocating his left shoulder. Ohtani got hurt sliding into second base when he was caught stealing in Game 2, leaving the field with the team's trainer. Dodgers manager Dave Roberts said he didn't have the exact diagnosis of the injury and that Ohtani is planning to play through the discomfort. The Yankees host the Dodgers for Game 3 in the Bronx tonight. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the programme, dueling economic plans.
I'm a believer in tariff. It's the most beautiful word there is. Tariff!
We will create what I call an opportunity economy, an opportunity economy.
That conversation up next. Equity futures on the S&P 500 negative here, or rather positive, by 0.5%. Used to saying negative because we only had one positive day last week. Down on the week last week for the first time in 7 weeks. Up this morning by 0.5%. Yields are higher by a single basis point. The 10-year 425.20. Under surveillance this morning, dueling economic plans.
I'm a believer in tariffs, giant tariffs. It's the most beautiful word there is. Tariff!
We will create what I call an opportunity economy, We will build, yes, what I call an opportunity economy.
I want to cut taxes on Americans while putting tariffs on China and foreign countries.
Ours that is focused on bringing down the cost of living for working families, investing in small businesses and entrepreneurs.
I will support a tax credit for family caregivers who take care of a parent or a loved one.
I will be laser focused on creating opportunities for the middle class that advance their economic security, stability, and dignity.
Here's the latest this morning. According to a recent New York Times Siena College poll, the economy remains the most important issue for voters in the upcoming presidential election. And 23 Nobel Prize-winning economists are siding with Harris. We believe that overall, Harris's economic agenda will improve our nation's health, investment, sustainability, resilience, employment opportunities and fairness, and be vastly superior to the counterproductive economic agenda of Donald Trump. One of those Nobel laureates is Joseph Stiglitz, and Professor Stiglitz joins us now for more. Professor, welcome back to the programme. Before we got into this, I wanted to go back to something you said about 6 years ago about the Trump administration at the time. You said no country could have a more unqualified economic team than Trump's, and a majority of Americans are not behind the trade war. Public support will wane even further as Americans realise that they lose doubly from this war. And as you know, sir, Harris and Biden did not remove many of those tariffs. They stuck with them. And in a recent Reuters poll, some 56% of registered voters said they were more likely to support a candidate backing a new 10% tariff. So, Professor, thanks for bearing with me. The first question, how much daylight is there between what you think this country needs and what this country seemingly wants?
Well, there's a very, very big difference between Harris and Trump on these tariffs. Trump has talked about 100% tariffs and tariffs even on our allies, whereas Harris has talked about very moderate tariffs on China. And the reason for those moderate tariffs is, like it or not, we are in a new Cold War. And we have to de-risk. We have to reduce our dependence on China. And that 10% tariff is a signal to our business community of where we're going. The 100% tariff that Trump proposes will be extraordinarily disruptive, lead to significant inflation, and in the end, result in a tax, in an inflation that particularly hurts those in the middle and the bottom because it's a tax on the goods that they buy.
Professor, we've heard from Biden administration officials, though, like the Treasury Secretary Janet Yellen, talking about the fact that China is unfair on the global market, that they dump on other markets. When I talk to Trump advisors, they say they want reciprocity with free trade. So how do you get there?
Well, first, let me say that some of this unfair allegation is exaggerated. The fact is, the reason that China is ahead of us in EV is they recognized that there was a need to a green transition 20 years ago. They have an enormous scale. They have high competition among a number of firms. They have many more engineers than we do. They've been training a lot of them, some of them in the United States. So they have a, you might call, natural competitive advantage, which they've taken advantage of. And then in addition to that, there's been some subsidies, but we've been giving enormous subsidies too. So I think as we think about where we are on this, we have to recognize that China today, not 50 years ago, but China today has some comparative advantages in certain aspects of manufacturing.
Professor, the U.S. has given subsidies when it comes to the Inflation Reduction Act, when it comes to the CHIPS Act. Do you think the U.S. is subsidizing as much as China?
I suspect it's subsidizing even more. Those subsidies are now estimated by various experts at between $1 trillion and $1.5 trillion. And that doesn't include the $500 billion that we're giving in chip subsidies. Chips, of course, are an important ingredient in cars. So the fact of the matter is that we are giving massive subsidies.
So is the U.S. in violation of WTO rules?
Oh, unambiguously, the U.S. is in violation. China is probably in violation. My own view is that if we want to have a rule of law, what we should do, if we believe China is in violation, go to the WTO, present our case, and let the judges decide. The problem is the U.S. has defenestrated the WTO by not allowing the judges to be appointed, and so there's not a quorum. But let me go back to the point that you raised. There is no comparison between the economic policies of Trump and those of Harris. Policies will lead to more inflation, larger deficits, lower economic growth, and enormous amount of disruption in the short run.
Professor, why do you think that didn't happen under Trump in the first term?
Well, the difference is that he now has unambiguous control of his party. Let me give you one example. You mentioned the letter from 23 Nobel Prize economists. There was a letter from more than 80 Nobel Prize scientists. Every year almost during Trump's administration, he proposed massive cuts in our science budget. Fortunately, a bipartisan agreement among Democrats and Republicans knew how devastating that would be for the U.S. Our strength lies in science and technology. You cut those budgets, it's going to really weaken the United States. And that's why more than 80 scientists, Nobel scientists, came out in support of Harris. Today, he has such control of his party. If there were a Republican Congress, those cuts might be put into place.
And this is a conversation you and I will have, no doubt, in the near term, in the near future. Thank you for being with us, sir. As always, Professor Joseph Stiglitz there on the latest on why he's siding with Harris's economic plans.
The Fed is biased to cut, and that should perpetuate unless you think the labor market will tighten magically.
In my mind, the labor markets are still broadly cooling.
You would not suggest that this economy requires a real interest rate of 3%. I think there's at least 2 more cuts that are coming.
We see inflation actually surprising to the upside into the first quarter of next year.
The result is probably somewhere in the middle where it's soft landing. That said, the no landing has probably not run its course yet.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the opening bell, equity futures up by 0.4% on the S&P 500. Your bounce back this morning looks like this on the Nasdaq 100, up by 0.6. What a year the next 2 weeks will be, including this week. Earnings from the likes of Microsoft, Apple, Google, Amazon, Meta, data coming through the week, including JOLTS tomorrow. And then the big one on Friday, payrolls just around the corner. Then next week, we've got Election Day on November 5th. And then 2 days later, a Federal Reserve meeting.
I think people want to put aside the will he win, will she win kind of debate for now. Just some people, because there are earnings and economic data coming out that can really come to the fore. That's what Peter Scheer was making the argument, at least, of Academy Securities. How much are we going to see some answer to whether it is the economic fundamental data that's been driving some of the recent increase in yields and rise in stocks, or whether it really is the belief in what the outcome is of the election?
Well, people have been waiting waiting potentially on the sidelines. Companies are talking about, when you look at some of the survey data, they want to see some clarity. Financial markets want to see clarity to understand what the policy might be in Washington before they go out and make big decisions. Even some consumers. What did we hear from analysts? People are not flying this week. Apparently, people don't go out and buy real estate this week or next week. They want clarity on the U.S. election before they can make any decision. So I care about the earnings. I care about the data, but I think the outcome of the U.S. presidential election weighs a lot more.
Election day, a week tomorrow. Here's some clarity on the bond market. Yield to higher once again, up 2 basis points, 426. Double-digit basis point moves on the week last week on a 2-year and a 10-year. That's the story of the bond market. In foreign exchange, the euro just a touch stronger, 108.21 on euro dollar, up by 0.2%. And to round out the check for you, we've done equities. Here's commodities. Crude lower by 6%, $67.50. Coming up this hour, we'll catch up with Liz Young-Thomas of SoFi, with stocks climbing ahead of a pivotal week for markets. Angelo Zino of CFRA previewing earnings from Apple. And we'll catch up with Lara Rhame of FS Investments, looking ahead to the October payrolls report. We begin this hour with stocks climbing and bonds falling ahead of a pivotal week for financial markets worldwide. Liz Young-Thomas of SoFi writing, expectations for a strong economy have risen, while expectations for more aggressive rate cuts have fallen. The commensurate rise in yields reflects the more optimistic economic outlook. Liz joins us now for more. Liz, welcome. Loved your note. Very simple and direct. Just a deep understanding of what's happening in the bond market and what it means for stocks. So let's start with fixed income. Walk us through how the shape of the yield curve is changing and what's leading that move and what it might mean for equities and where you want to be.
Sure. So what's been happening since the yield curve came out of inversion, and actually as it was approaching that steepening level, is first we had what was called a bull steepening. And when we talk about bull and bear in these terms, we're talking about the bond market. So that was bullish for bonds. But more recently, we're continuing to see a steepening, but it's really what's called a bear steepening, which means that yields have been rising across the curve. So they're rising at both the 2-year level and the 10-year level, but rising faster at the 10-year level, which continues to make the spread between 2s and 10s wider. Now, initially, as that happens, it's usually positive for things like banks because you get optimism over net interest margin increasing as the year goes on. As long as that holds and the economy stays healthy enough, we don't see this big tick up in delinquencies, that continues to be positive for financial markets. We're also starting to hear that there might be some reignition in the IPO market, capital markets activity, particularly in 2025 once we get past the election. And that has been positive as well, particularly for financials. Now, what you want to watch is that after that phase, it could end up being that the steepening of the yield curve or a rise in yields ends up being the result of inflationary fears or perhaps some sort of shock to the commodity market. And at some point, those rising yields do start to make equities nervous. I think right now we're right around that level where equities have taken a pause and said, hold on, yields have risen a lot in the last month or so. Let's make sure that this isn't going to tighten financial conditions too much.
So Liz, let's build on that. Is it the level or the reason? When it really comes down to it, are we entering that zone right now in the bond market at about 425, where we're entering this zone regardless of the reason? Or do you think that equities will stand up to this so long as the data produces continued upside surprises on things like payrolls on Friday?
So I think the reason recently has been economic strength and some positive economic surprises. I even put a chart in my recent note, just basically breaking down what's happened this year. So earlier in 2024, we had economic surprises negative for the most part, but we also had inflation coming in hotter. So people got nervous about that. Yields were rising, but it was because inflation was coming in hotter. Then middle of the year, we had inflation sort of cool down. You see yields start to fall. And then we had this inflection point where economic surprises came in positive again after the first Fed cut. So I think that's been the real key, is that we've had strong economic data even in the beginning of this cutting cycle. Now, the other part of your question, is it the level that matters? I do think the levels matter, and I think there was a key level right around 425 in the 10-year where equities took a pause. Now, a pause is not a bad thing. It doesn't mean that there's going to be this big correction coming, but just a pause to see, perhaps it's to wait until the election is over. Can we withstand this through the election? And then some of the next stops are probably 430, 4.50, and we're even hearing people talking about 5% as a possibility on the 10-year. I'm not necessarily in that camp right now, but that would be a level that I think would absolutely pressure equities, and probably before then you'd see equities get pressured.
I wonder how much this really goes to the story of the pause that we're also seeing in the outperformance of the broader index or even small caps, and whether this is sort of a tipping point of sorts for you, given that the underperformance of bonds has really come in tandem with the shift back to the Mag 7.
Yeah, so the shift back to the Mag 7, I feel like at this point is a tale as old as time. It's as if investors just go back to the Mag 7 in good times and bad times and sideways times, and when there's nothing else to do. I think as the economy moves forward and as we continue to get more data, if things stay stable, what we are more likely to see is the continuation of that rotation. So out of big tech, not because something's wrong with big tech, but because it's been such a winner so far, and investors are going to search for growth in other areas. So I've talked about this over the last few weeks. If investors are searching for growth in other areas, I think healthcare could be actually a big beneficiary of that. And a lot of those cyclical sectors that have shown signs of life will also need to come through in earnings, and we'll get a good test of that this earnings season. They need to come through in earnings and pick up the weight that perhaps the Mag 7 needs to slow down on. So I think the shift out of the Mag 7 is somewhat due to yields, but I think more so due to the idea that the economy is still strong. Cyclical sectors should pick up. Now, to your question about small caps, I think some of the movement in small caps is also due to that cyclicality. We obviously can't really explain it by a huge rise in yields that usually pressures small caps. So if we're headed into a period where we're in this more mid-cycle expansion, you should see some life from small caps. But that's a part of the market that continues to give me pause because it still has not made new highs. We've tried to get it off the mat a number of times through this cycle, and it hasn't happened yet. So I think small and mid-cap stocks are still waiting to make sure that the labor market is intact, perhaps through the end of the year, because those would be much more sensitive to moves in labor.
If you put these two ideas together, I wonder how important the earnings season is going to be this week, given the fact that the big tech players have really been the supports to an economy that's actually otherwise not doing that great. Sort of this secular overlay of the AI theme. I'm wondering if you do get an outperformance from the big tech players this week, does it almost take away from the rest of the story, showing that they still are the main drivers, a lot of the strength that we're seeing in the economy?
At this point, I think because it's happened for so long, I think big tech ends up being more of a sentiment test than a big driver. So I do think earnings season is important, but obviously this earnings season, there's a lot of other cross currents going on, a lot of other competition for headlines with the election coming up next week. So earnings season perhaps not quite as anxiety producing and perhaps not quite as market moving as it's been in past quarters. But the Mag 7 will continue to be a good litmus test for sentiment and for investor sentiment, particularly with the idea of, are investors still willing to pay up for this? Are we still willing to pay up for the growth that these could produce down the road? Now that we've really realized that this AI theme is not something that's going to create profits and tangible impact maybe by the end of this year, it's going to take a little bit longer. So I think from a sentiment perspective, they still matter. If they beat and continue to go up in this market, I think that's a good thing for sentiment. If we get, for some reason, a surprise miss or some kind of surprise negativity, I think that would hurt sentiment a lot in the broad market.
Liz, you keep coming back to the cross currents of the time and the fact that we're going to get these election headlines. And then at the same time, you're talking about the sentiment of these big tech players. Is there a political outcome that's better or worse for them?
I don't know that there's a political outcome that's better or worse for them. I think that it really depends more on what's going on in the broad economy and what's going on with risk appetite in general for investors. And I think risk appetite has taken a little bit of a back seat right now. Not that it's gone away, but people have just slowed down. And I think earlier in the show, you were speaking about people just waiting even through this week and next week to do big purchases, to make big decisions. So I think the same thing is playing out in the market. And a lot of it is going to be about how much is each dollar of earnings worth to me as an investor. The sectors that are typically more sensitive to elections, I think will traditionally be more sensitive this time as well.
Hey, Liz, wonderful to hear from you. Liz Young-Thomas there of SoFi, just piecing the puzzle together between the equity market and the bond market. I want to sit on the bond market. 2s10s, positive 15 basis points, up another single basis point this morning. We've had a 60 basis point plus move since the Fed reduced interest rates by 50 basis points back in the middle of September. It's been quite a move.
Some people suggesting that this kind of raises a question about the, I don't want to say wisdom, but wisdom of cutting by 50 basis points. Is that almost a mistake? Because in some ways, it's actually tightened financial conditions based on how much yields have risen on the long end. Is that an indication of an inflation picture, an inflation call, or is this really having to do simply with the election and the potential outcome?
I'll save my opinion. Ed Yardeni of Yardeni Research earlier on this morning, too much too soon. That's what he thinks, and he thinks it's led to a melt-up in the equity market.
Yeah, well, Mark Rowan also talking to you about this of Apollo, this idea that this economy isn't slowing down, and you're hearing that from a lot of different places. So the question is now, when do we start to price in inflation? Are we going to see some pretty messy auctions this week?
This data and this story can change pretty fast, so look out for the economic data through this week. Payrolls on Friday. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Volkswagen top labor leader said that the company is closing at least 3 factories in Germany. It's part of a plan to cut costs and become more competitive. Europe's biggest automaker is also planning universal pay cuts of 10% and shrinking all remaining sites in the country. It's also considering divesting entire departments and divisions, outsourcing to other service providers, and moving work abroad. McDonald's is bringing back the Quarter Pounder. The fast food chain ruled out beef patties as the source of an E. coli outbreak that had sickened dozens and left 1 person dead. The infections appear instead to stem from the slivered onions that are served on top of the hamburger. Quarter Pounders will return to all restaurants this week without the onions. And the good times are rolling for the Kansas City Chiefs. The 2-time defending Super Bowl champs are still undefeated after taking down the Raiders in Las Vegas yesterday. They hold the league's last perfect record, with every other team racking up at least 2 losses. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next, we'll get you some morning calls. Plus, Angelo Zino of CFRA previewing earnings from Apple. Those results drop in a little bit later this week from New York. This is Bloomberg. Just a little more than an hour until the opening bell. Equity futures on the S&P 500 here up by 0.4% on the S&P, and the bond market yields higher by a single basis point on the 10-year, 4.25. Let's get you some morning calls. First up, Jefferies reiterating its buy recommendation on Boeing, saying markets have already priced in the company's move to raise additional capital. That stock is down by 1.6%. Your second call from Stifel downgrading Colgate to hold, expecting organic sales growth to slow from high single digits in recent years. That stock is negative by 1.4%. And your third and final call from Canaccord, raising its price target on Tesla to $298, citing accelerating profit trends. That stock up again this morning after a move of more than 20% in a single session just last week. We're up by another 0.8% in the pre-market. Turning to tech, Angelo Zino of CFRA remaining bullish on Apple ahead of Thursday's earnings, writing, "We expect Apple Intelligence to help support incremental consumer upgrades driven by loyalists and an aging installed base. With AI being more evolutionary than cyclical, that will aid multiple years of growth." Angelo has a buy rating and 260 price target on shares of Apple. He joins us now. Angelo, welcome to the program, sir, to talk about Apple. This is what we heard from KeyBank just last week. I'll share this with you from one of your peers. Unrealistic growth expectations. Angelo, how realistic are growth expectations right now, given that we have the new hardware, but we don't have the upgrades to the software just yet in terms of the AI features we're all looking for?
Yeah, no, thanks for having me. So, when we kind of look at all this, it's definitely been kind of a mixed picture thus far since kind of the iPhone 16 launch. And what I would say is, some of the expectations that we've seen out there look a little bit aggressive. And part of the reason is there have been a number out there kind of calling for kind of this super cycle with the iPhone 16. And we've kind of been on the other side of it in the sense of saying, listen, the iPhone 16 is probably going to be a growth cycle, and that's a good thing, because the last 2 cycles were no growth to slightly decline cycles for the iPhone 15 and the iPhone 14. So that said, you've got some easier comparisons here. You do have that aging installed base. And that launch of Apple Intelligence, is going to kind of get trickled out here over the next 6 to 9 months or so. And, we expect some great things to kind of come out of Apple Intelligence. And we're excited to kind of see what developers are really going to kind of do, specifically as they integrate Siri across their ecosystems. But that said, again, we're looking for the iPhone 17 to be better than the iPhone 16. And we're looking for, at least for this cycle, maybe closer to a mid-single-digit growth rate, where others might have been a little bit more aggressive as far as the hardware side of things is concerned.
Angelo, do you think they're vulnerable in certain geographies as well? I'd love your thoughts on China, because we've had some conflicting reports from certain companies. LVMH and Starbucks both highlighting a weaker consumer. We had one report on Apple, I think it was Counterpoint Research, that said that maybe sales were ahead of where sales were this time last year with a new product. How do you read things there?
Yeah, listen, I think it's kind of similar to what, we've been hearing about kind of the start of the iPhone 16 cycle, and that is it's been very mixed in nature. The way we're looking at China right now is, we are looking for a return to growth, again, after 2 years of no growth out of China. Again, it's one of those situations where easier comparisons, especially as we kind of look forward through this cycle, as you kind of go to the March and June quarters, where China was particularly hurt and where we kind of saw, some pricing pressure in terms of discounting and what have you. We do expect kind of the China momentum to improve as we kind of go into the March quarter specifically. But again, it's not necessarily going to be something that's going to be driven by significantly higher volume relative to maybe what we've seen in the past. So overall, it's going to be an improvement relative to what we've seen. And we actually expect Tim Cook to, in some sense, really kind of, he doesn't provide exact guidance in terms of the December quarter, but we do expect them to kind of talk about an improving trajectory for the iPhone and in China in terms of kind of saying potentially see an acceleration of growth in the December quarter versus September quarter. And hopefully that is enough to kind of keep some of the gains that we've seen in the stock kind of, where it is now.
Angelo, there is one person who I think is probably my test to see whether Apple is gaining traction with AI and this idea of whether you should actually trade up for the new model. And that is one Jonathan Ferro. And I haven't seen him necessarily come in extolling the benefits yet of artificial intelligence or even really fully understanding whether this is going to be truly a game changer. So from your perspective, what do we have to see to make this the game changer that actually creates this upgrade cycle that everyone's been waiting for?
Yeah, I mean, and again, I don't expect to necessarily see kind of a big upgrade cycle, right? And I'll tell you this: I personally did upgrade to an iPhone 16, and I'm not necessarily someone that often upgrades in terms of the cycles, but I'm kind of in that camp where I've had a device out there longer than 4 years. Kind of the AI kind of tilt to this definitely intrigued me, and I think as it's going to be more of a word of mouth thing, right? I think as you kind of see some of these new capabilities trickle out, especially when you start thinking about kind of the second tranche and the third tranche, not necessarily stuff that you're going to see today. But, we start thinking about Genmojis, you start thinking about kind of the ChatGPT integration. And then, as we kind of go into more the Siri integrations, as you kind of go into Q1 and Q2 of next year, I think that's really where kind of the word of mouth starts to really heat up, and kind of the fact that the iPhone could potentially be that ultimate personal assistant closest to your device, the closest device to you out there. I think that's where it gets a little bit more interesting out there. I think especially kind of the Gen Z population out there, I think really starts getting a lot more interested out there for this device as well. So I don't know if there's anything specific that kind of gets you to go out there and actually buy that device. But if you start seeing more and more of your peers out there and your friends and what have you start upgrading, I think that could potentially get others out there to start upgrading, especially if you've held that device out there for north of 4 years or so.
Even without the upgrade cycle, since you don't necessarily think that's going to take off so quickly, Angelo, how much do you see this really being a services company increasingly, as well as an AirPod company? But how much of the service is really going to stave off any potential weakness?
So listen, I think the services tilt is really the most interesting aspect of this company. It's really kind of what's driven the gains for this company over the last 5 or 6 years. And specifically, if you kind of look at the number of analysts that have kind of thrown out potential super cycles, time in and time again, and it hasn't come to fruition, it's really because of the services side of things that has really held this stock up. When you kind of look at the September quarter here, we actually expect them to kind of surpass 25 billion in quarterly revenue, which gets you to north of an annualized revenue run rate of 100 billion for the first time ever. And when you think about kind of Apple Intelligence out there. We think potentially they come out with kind of, an Apple a Plus type of offering where they start charging $10 or so a month out there. Probably going to be at least 4 quarters out from now. But that's not something that's baked in this stock. And if you can get somewhere along the lines of 300 million users or so over the next 3 or so years, kind of, into that offering out there, all of a sudden you're potentially talking about north of 30 billion in annual revenue, just tied to the AI opportunity out there. So a big reason we think the stock continues to hold up as well as it is, despite the fact that I think an increasing number of people out there don't believe in this super cycle out there, is because of kind of the fact that you have that that potentially comes out there at some point in time, and that again drives higher margins out there. We think, again, the street is underestimating the gross margin potential of this company over the next 2 to 3 years. So there are kind of catalysts here for this story looking out, and it is going to be tied to that services side of things.
Angelo, we talked about China, we talked about AI, but we haven't talked about Europe, which looks like it's one thing weighing on Tim Cook's mind right now. According to the former president, Tim Cook recently called him to complain about these potential EU fines. How much is that a drag on Apple?
It's definitely something that Tim Cook doesn't want to have to deal with, but he has to deal with. So, I think it's a good move overall for him to kind of go out there and make that phone call to, potentially the next president out there in terms of Trump. But you kind of look at, how big of a deal it is. It's a big deal in our view. I mean, it's impacting kind of the innovation that we think on Apple's side of things. It potentially kind of has an impact in terms of the services opportunities out there for that business, and even potentially what they could do on the hardware side of things. And I think the bigger risk out there is, of course, whether or not kind of that trickles outside of Europe into other regions of the world. So, this is something that kind of, Tim Cook, definitely is concerned about, and, why you saw him kind of make that call out there.
Angelo, appreciate your time, sir. As always, Angelo Zino there of CFRA. With numbers from Apple coming later this week, big question about whether they'd get a carve-out if we got a Trump presidency and some aggressive tariffs.
A carve-out because they want to be able to have some of their inputs being made around the world. But what did Howard Lutnick, who's head of the Trump transition, who spoke at Madison Square Garden yesterday, tell you all around this table? No carve-out.
No carve-out. That stock is up by 0.4% in the pre-market. From New York, this is Bloomberg. Equity futures on the S&P 500 firmer here by 0.33%, call it 0.4% higher. On the Nasdaq 100, we're up by 0.5. With 1 hour away from the cash open, with your morning movers, here's Manus Cranny. Hey, Manus.
Jonathan, a very good morning. So much of today's news flow is about the calibration of response. When do you make your move? VW or Boeing? Kelly Ortberg choosing today to go in for the real defense. About 5% of Boeing is held by the banks. Remember that. 5% of this stock and a huge amount of risk exposure is held by the banks. So we're going for 90 million common stock and $5 billion of depository receipts. The cash burn, about $14 billion for the year. But this is about shoring up the defense from an equity capital markets raising to a credit line bolstering up defense of the realm with about $25 billion and flying kites about what comes next in the recalibration of Boeing, which could be the space business. Do you spin it out? It could be the winning opportunity. And again, that's just one of the kites that's being flown about what shape is Boeing going forward. Roll it forward. $20 trillion of equity market capitalization will report this week. 5 of the Mag 7 will deliver their numbers. And you really want to focus on 40% of the sales for NVIDIA are going to come down the pike this week. $56 billion worth of capex is what is expected from the hyperscalers. And that is what will embolden and underpin NVIDIA, which made another record high last week. Leave you with the fact of the day. Mag 7 peaked out on July the 10th, and Mag 7 are now down 2% relative to the rest of the market, down 2% from their highs. A snapshot of what's going on with oil. Oil's down nearly 6% at one juncture. We take this phrase, relatively limited response from Israel onto Iran. Be careful how you calibrate that. Be very careful about how you interpret that. Either way, the drag on the market this morning is big oil, Exxon, Chevron, any of them. Just take a look. That's the drag. Disruption. and the opportunity. Jonathan, good morning.
Crude getting hammered. Manus, good morning. Good to see you, as always. Let's turn to the data. Investors bracing for a host of eco data due out this week, culminating with the October payrolls report on Friday. Lara Rhame of FS Investments saying this: my outlook for the employment data is a little above consensus. I think we get a 150 increase with the unemployment rate steady at 4.1%. Lara joins us now for more. Lara, welcome to the programme. 150, in a grand scheme of things, is actually pretty punchy. How much have you taken off for the strikes? How much have you taken off for the hurricane impact?
I think, the strikes were a little later in the month, so I'm more focused on the hurricane impacts, which I think are going to take about 50 or 60,000 off. I think we're in a world where we're actually still getting a really robust employment picture, despite the fact that we're seeing so much uncertainty coming into the election.
So, Lara, with that in mind, is 150 enough to hit pause at the Federal Reserve?
I don't think so. I think the Fed is clearly signaling that they want to make this first initial step of reducing rates. And, I think the unemployment rate is going to stay steady around 4.1%. There's more than just one number in this very significant report. We've also seen wage prices ticking up. I think there's enough else here to make them want to keep adjusting that real Fed funds rate lower. Remember, as inflation's come down, the real Fed funds rate has actually risen significantly. So that's a recalibration that I'm thinking of more than a big easing cycle.
If they do cut again by 25 basis points and we get the 150,000 number that you're expecting on Friday, does this lead to a much further steepening in the yield curve? Do you start to see 10-year yields rise really substantially?
I've been in that camp that is expecting a bear steepening for quite some time. I think that long duration trade, if you blinked, you missed it. It's over. And, looking ahead, when we think about renormalization of the yield curve, it's a two-step process. In the short-term part of the curve, interest rates are coming down. The Fed is, of course, cutting. But, you look at the 10-year historically, rates are usually 150 basis points above the Fed funds rate. It's not like that's my forecast today, but I think that upward pressure on the long end continues as long as the Fed rate cuts stay relatively moderate, which I think they will.
Meanwhile, I'm looking right now at five-year forward break-even rates, basically the expectation for inflation between 5 and 10 years. It's actually come down. This doesn't seem to be as much of an inflation and growth story as some people are suggesting, that actually it's a real yield story of real yields increasing. How do you really parse out the idea that the increase in yields really has been due to the 50 basis point rate cut, or this idea that the Fed wants to get a lower real rate? How much can we really understand that based on the fact that it seems like there's some other factors here at play?
There are so many other factors. And I think it's, we're seeing sort of a perfect storm of things which are pushing rates higher, because it's a combination of, expectations of inflation next year, given the election outcome. And I think people leaning into a bit more of a Trump victory. I would say that I think inflation is due to notch higher, or at least stay stubbornly stuck where it is, no matter who wins. And then you've got debt and deficit dynamics. Those are deeply unfriendly, and interest payments on the deficit have gone parabolic. That's also something that's going to be in place no matter who wins. And then finally, I think, the solid growth story continues to be an underlying part of this Fed rate cut cycle. We just do not have many examples of the Fed cutting rates when we don't get a recession. And when we have seen that, the Fed has been much more cautious in cutting rates than sort of a traditional cutting cycle, which includes a big economic slowdown. Hey, if the economy stays where it is, I think long-term rates are due to continue to rise.
Well, would they be cautious on November 7th? You don't think 150 gives them reason to pause? What number would?
I don't think it's about one number on the payrolls. I think if we get the unemployment rate down sharply, if we get a big retracement of wages, but I don't think the Fed ever moves off of one piece of data. We've seen, some unfriendly CPI numbers. We've seen, the wage data. We've seen, a bunch of culminating data, which I think reinforce their notion that it doesn't hurt to just sort of bring rates down slowly this year, but then pause in the beginning of next year. I think when I'm in the Fed seat, the rate cuts are already priced in. I might as well walk through the door. But the beginning of next year, I think it looks very different. I think that's when they pause. I don't see any rate changes in the first half of the year. And I think that's still where the markets got it wrong when they're pricing in all this policy accommodation.
And they pause next year, regardless of the outcome of November 5th.
You know, I think they always wait to see policy in place. When you talk to them, it's not sort of campaign rhetoric or hopes of policy that make them change their interest rates. It is really seeing policy in place. And I don't think any of us really expect any meaningful changes in policy until, until the first quarter, second quarter. All of that's got to get through Congress. That's maybe one of my key takeaways to this election. Congress matters. So when we think about the tax cuts or changes in tax policy that would really affect the consumer and the trajectory of growth significantly, I think they wait to see what really comes down the pike in terms of the votes and what is actually, in place in a policy way.
Lara, thank you. Always appreciate your time. Lara Rhame there of FS Investments. With us around the table, Noel Dixon of State Street Global Markets. Noel, good morning. Good to see you.
Good morning.
We've got a lot to work through, so let's get to this. You say the next 2 rate cuts will be easy. Would a 150 on Friday make it harder?
I don't think so. I think, the Fed keeps in mind the QCW revisions. So what we see, could always get revised away. So I think the next couple of cuts, are baked in, and I think that's justified. But then we get to the conundrum about where the neutral rate is, and that's when it starts to get fun.
Where do you think it is?
I think they start to get into that conversation early next year. Our view is that we think it's probably at least 3.5%, could be as high as 4%.
Do you agree with what we were just hearing from Lara Rhame, that potentially they could not cut it, they couldn't cut it all in the first half of next year?
I think it's a real possibility because they are cutting into strength. And basically, financial conditions are still really easy. If you look since Q4 2019, household net worth is up over 30%. So those impulses in the economy, I think, certainly could cause inflation, if we're being honest, to probably reaccelerate itself.
Which is the reason why I think it's interesting that we haven't brought up PCE, core PCE, which we're getting on Thursday this week. And the expectation is for it to tick up, actually, to potentially even the highest going back to March. Do you think that that's going to be really negatively received by the Fed, that will sort of enforce this idea that we heard from Lara and yourself, that potentially they will not cut it all during the first half of next year?
I think it does, because if we're being honest, Supercore, last in CPI was up about 40 basis points month over month, and then year on year it's still above 4%. And that excludes housing, which is still pretty sticky. So I think the mission as it relates to core inflation is not done. And I think there is a risk that you could see some reacceleration or even some real stubborn stickiness.
So what does that mean in terms of economic growth versus just inflation for supply side issues, right? There's a sort of a dual issue here that some people are saying, well, it might be good to buy stocks because if it's a growth story, then that's positive. Other people might say, well, if inflation is picking up because there are these different fissures in trade lines and there are different disruptions in the Red Sea and other kinds of complications, that's not so great. So which is it?
Yeah, so I think why they don't cut is important. So if they don't cut because they recognize neutral is higher because of just structural changes, then that's a decent story as it relates to real growth. But if they don't cut because there is concern about reaccelerating inflation, then that could choke off growth, and I think that'll be more of a negative story.
No, I wanted to get your thoughts on the election. You say the biggest concern going in is the red wave, because that might push yields closer to 5%. But why wouldn't a blue wave also push yields higher?
Yeah, I think our perspective is that we think 5% probably ultimately will be the goal. But how we get there is important. So if we get a blue wave, then I think it's more of a gradual process to get to 5%. But if you have a red wave, we could get a nonlinear sort of volatile pathway to 5% that happens in short order. And that would cause, I think, a lot of volatility and concern.
What drives that differential in the timeline?
I think the baking in the higher fiscal spending under the Trump administration, which based on dynamic scoring is about over $4 trillion. With Harris, it's about $2 trillion. which is still significant. But I think, that, with the red wave, you could get that, you get the tariffs, and I think it just introduces a lot more concern.
How much do you think we have discounted so far, just in terms of a red wave? There's been some discussion in fixed income about that, at 425 at the moment on a 10-year. How much of that do you think is priced?
Yeah, I think when we look at it, we actually have a measure through our narrative map. We think it's some getting priced in, but I don't think it's fully appreciated because in the polling, betting markets, you have to separate betting markets from the actual polling. Betting markets are, showing a higher probability. But if you actually look at the polling in the swing states, it's still pretty tight. So I do think it's more of a 50-50 situation.
I find your argument quite persuasive. If we wake up on Wednesday and we've got a red sweep, what kind of moves are you thinking about? 25 basis point moves, bigger than that?
I think probably not bigger than that in one day, but I do think it'll be, a nice spike, in especially the long end, 10-year. Yeah.
No, appreciate your time. Thoughtful stuff. Thank you. No Dixon there, State Street. The 10-year at the moment, 4.25. Did you find that persuasive? I did. I've got some sympathy with that view. I see a big debate right now happening on the South Side. To what extent is this GOP sweep priced? And I think, sure, a little bit. Entirely, I'm not so sure.
I would agree with that. I don't think that people are necessarily fully pricing that in, given the fact that it's not a certainty. But I think it's something like 48% chance in the betting markets that you get actually a red sweep. But there is a 12% chance only of a blue sweep. I was reading some probabilities. So at least that might be priced out a little bit more, which is the reason why maybe it's the 50-50. It is persuasive to me.
A lot of conviction people have going into this election is that the Senate is going to be red. And not only is it going to be red by a small margin, I think what you're seeing play out in some of the betting markets, not the polling markets, to Noel's point, is the fact that you look at the Cook political report. These Democrats that are defending seats, say in Wisconsin, in Pennsylvania, they were supposed to be lean Dem. They are now toss-ups. So the bond market, I think, and maybe investors are waking up to the fact that maybe if Trump wins, it might actually be a blowout in the Senate and more of his agenda could get done.
It's not just about whether it's a blowout or not. It's the agenda and the platform. I still think there's a big degree of skepticism about how many of these efforts, these policies, he'd actually try and push through and how quickly he'd be looking to do it. That's where I sense some skepticism still.
Well, I think it depends on what the policy is. When it comes to tariffs, he could move relatively very quickly. Do you take him at his word? Do you take him seriously? Do you take him literally? If you take him at his word, are you going to get a 10% tariff rate and 60% on China? Or do you take him as one of his economic advisors, Scott Bessent, says, this is a negotiating tactic. You're looking at 2.5% on Chinese imports into the United States for tariffs for 2 years. And then Xi Jinping comes to the table and says, well, now it bites, we're going to stop. It depends on what you take from these campaign promises. Don't even get me started on taxes. What you take on campaign promises and what actually happens if we were to see a Trump presidency.
The 10-year right now, 124.60, or rather 424.60. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
John, former President Donald Trump held a nearly 6-hour rally at New York City's Madison Square Garden yesterday. Trump was joined on stage by roughly 24 speakers, from Elon Musk to celebrity wrestler Hulk Hogan and House Speaker Mike Johnson. The rally featured criticisms of Vice President Kamala Harris over the border, crime, and the economy. It also included a comedian who made off-color jokes about Latinos and called Puerto Rico a floating island of garbage. Falling used car prices are creating a financial risk for millions of drivers. According to the Wall Street Journal, about a third of people have loans that are larger than the value of their car. The paper cited a survey by auto marketplace CarEdge. Being underwater isn't uncommon, given how much a car loses value once driven off the lot. However, used car prices have dropped 19% since 2022, creating a higher than usual share of underwater loans. The Yankees are looking to turn things around at Game 3 of the World Series tonight. The Dodgers are leading the best of 7 series, 2-0. Tonight's game will be at 8 p.m. in the Bronx. The blockbuster matchup has been a ratings hit so far, an average of 14 million viewers. That is a 7-year high. The Yankees are hoping to get a boost from star Aaron Judge, who has had just 1 hit so far in the series. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead and we'll catch up with Anna Wong of Bloomberg Economics. Anna Wong of Bloomberg Economics is looking for a negative print in the jobs report on Friday. Stay tuned for that. These are the scores, up 0.5% on the S&P 500. In the bond market, just about unchanged, the 10-year at 4.24. Manus identified some of the movers in energy to look for to the downside with this move on crude, down by more than 6%. WTI 67.26. Here's your week ahead as we count you down to the opening bell. Stacked, absolutely stacked. Today, Ford reporting after the close. Tuesday, we'll get JOLTS data plus Google earnings. Wednesday, initial GDP data and earnings from Meta and Microsoft. Thursday, the BOJ announcing a rate decision, and in the US, another round of jobless claims and core PCE, plus results from Apple, Amazon and Intel on Friday. October jobs report and PMI data. Joining us now to look ahead to the payrolls report, Anna Wong of Bloomberg Economics. Anna, welcome to the program. In the survey we do at Bloomberg, your number is right at the bottom, negative 10K. Anna, walk us through where that's coming from, the process you've gone through that leads to you ultimately forecasting this number for Friday.
I think the biggest challenge in forecasting this Friday's number is the weather effect, the effect from Hurricane Milton and the lingering effect from Helene. And our team has forecasted the hit from weather would be approximately 175,000. We use a variety of processes. We use home-based data, and the home-based data suggests to us that a lot of the sectors that's sensitive to weather, and also the states that are in the path of storm, were pretty seriously hit. And we also looked at FEMA maps and mapped it into QCW employment, and we saw that the highest possibly number of jobs that are affected in the path of floods were about 12 million. And a lot of these numbers are quite similar to Irma from a couple years ago. And that hurricane also hitting Florida led to a 200,000 hit to payrolls in that month where it hit. So we think that that's why hurricane alone could possibly bring the payrolls down to negative. But I think it would be, I think a lot of market participants would be dismissing that print as entirely due to weather. But I think there are other cyclical factors at work, including weaknesses in manufacturing sectors that actually preceded the hurricanes. We also saw from high frequency data that the state and local government and education sectors were unseasonably weak. On top of that, a very widespread slowdown in professional and business hiring.
But Anna, given all of that, why don't you see the unemployment rate rising?
Right. So in the past month, we documented that the unemployment rate has seen a support from election workers, including emergency response worker. So in the household survey, people who are not at work due to weather would not be counted as unemployed, as in the payroll survey. So you don't get that negative drag in the unemployment rate. And on top of that, you get this boost from the household survey, putting a lot of weight on these government workers and election and FEMA response workers. So as a result, we see that it will stabilize at 4.1.
You've had a more sort of pessimistic view of the economy than a lot of people. Have you been surprised at how resilient the economy? What do you think has sort of been the reason behind some of these upside surprises?
Yeah, so on the unemployment rate, we were more bearish than most people, and we were right since most of this year. The last 2 months of payroll where the unemployment rate dropped, that was a surprise to us. And so we did a deep dive on what's driving the unemployment decrease, because I do think that if the unemployment rate continued to decrease after the Fed cuts, that is a sure sign of soft landing. But what we found as drivers of the slow decrease in unemployment rate in the last 2 months, we think is transitory. A lot of it is actually related to disasters and election-related temporary boost, which we think will go away in December.
Anna, we can leave it there. It's good to catch up. Anna Wong of Bloomberg Economics with a big call for Friday, negative 10K. The range is pretty large. 164K is the high. That comes from RBC. The median is 110. There is a lot of noise in this report. Anna's call, though, goes beyond just the hurricanes and the strikes. She's talking about cyclical weakness as well in this economy.
In particular for manufacturing, and we have seen manufacturing come in light again and again. At the same time, there have been some signs that maybe it's recovering just a bit, and there's a question of whether the weakness is now moving to services. That said, a lack of understanding just more broadly of what weakness is, what it looks like, because really, even if we get some of these numbers and the unemployment rate stays at 4.1%, are people going to get concerned? Are we going to see that risk-off move, or are people going to take this as, frankly, just simply messy data?
And if people just take this as messy data, a lot of people coming on saying it's going to be muddied. We're still bullish on the market, but we have a low print because of everything that's going on with the hurricanes, with Boeing. That's why I care about the revisions. 254,000 jobs, that September payrolls report. Does that get revised to the downside?
That's what Lisa was looking for 2 months ago. Can you imagine if those revisions happen after the election? We get those downgrades after the election. Can you imagine the political pushback we'd see?
Yeah, that's going to be we're going to have lots of fun,
really
kind of conspiracy theorists. I mean, honestly, this to me, yes, I don't even want to imagine what that's going to be. Tomorrow, or on Friday, let's see what the revisions are. If we get revisions to the upside, though, that would be interesting, too. And we have gotten some revisions to the upside. But you're right. How much political accusation could you end up getting?
There's been, what, 600,000, 800,000 revisions to the downside already this year? I think people already have them baked in, election or not.
Sort of mentally taking 60K off that number. Coming up tomorrow, Lisa Shallard of Morgan Stanley will catch up with former World Bank President David Malpass. We'll speak to Tom Becker of BlackRock and Mona Mahajan of Edward Jones. A big week. The election night, a week tomorrow. Big week ahead before we get there. Tons of earnings. Lots from big tech and some big reports on the data side of things with payrolls this Friday. From New York City this morning, good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.